So today we're going to be talking about reading number 100, 101 and 102. Okay. And then tomorrow we will take the other chapters 103 and 106. So we're going to be talking about that tomorrow. So let's start with the very first chapter. Okay. And that is going to be reading number 100, Advances in Artificial Intelligence Implications for Capital Market Activities. Now, the entire chapter that it talks about the implications of adopting AI. Okay, so we're going to be talking about why we should adopt AI, right? Because it really helps us in all the automation and other tasks. But apart from that, if you incorporate, right, at a high level, what is the implication towards financial stability for the regulators, for the overall financial system? That is what this chapter is all about. Not something I would say that every year GARP they do like to ask about the AI and everything, but the chapters that we have for 2026, uh, it is good, right? It's not something that you really have to remember a lot of things. Just know upfront as to what these things are, and you would be good to go for the exam. Okay, so you just need to know it. It's not something that will require you to remember a lot of things. That is the very first thing. Again, apart from this, very quickly, I'll tell you that this is a required reading from GARP. And I went to the, you can find this particular report from the GARP website. No need to refer this, okay? It's about 30 pages long. No need to refer it. Uh, but I'll just walk you through very quickly as to some of the diagrams that is going to be useful so that you can remember it for a longer period of time. Okay, that's the entire whole and soul purpose. Okay, so let's go with this particular thing. The very first learning objective, describe current uses of AI and machine learning in the capital markets. Now, basically, this entire chapter is based on the survey, the report that I just showed you, right? That was done by International Monetary Fund. So they did a survey across buy side companies and sell side. Okay, and 27 firms were collectively, were part of the survey. And this is the findings that we're going to be talking about in this particular chapter. AI models are classified into two things. One is a traditional AI that we are all familiar with, right? The decision trees, clustering, natural language processing, something that does the task as you give an input and it just does that particular task, right? You want to divide that into two components, you want to have a decision tree, classification, it does only those specific tasks that it is designed to do so. But now, in today's time, we are living in the world of advanced AI, and these AIs, they have large language models, there's deep learning, reinforcement learning. That means the AI automatically learns. Okay, it's like you provide an input and it will give you the output no matter if it is wrong. It will reinforce, it will learn by itself, and probably over a period of time it will give you correct output. So that is the advanced AI, and specifically we refer it to as the gen AI, right? Generative AI, which essentially means that you are generating as per the prompt that you actually give. So the better prompts, the better the outcome would be. What are the key benefits of implementing AI in the capital markets? Okay, what are the benefits? Of course, efficiency would go up, productivity naturally it goes up, and
Everything
overall
actually
accuracy as
drops.
compared to
People have
probably a human, right? It can lead, it can also go up. That's one of the key benefits. You have improved investment frameworks. You can allocate the with the help of AI you can design allocation strategies, so on and so forth. So overall investment frameworks, that is improved. And crash risk measurement, you can analyze it very quickly that, okay, whether there's going to be a market crash or not. So these AI can actually help you. And better use of unstructured. See, as I said, traditional AI, you give the data, it's okay, it's going to classify, it's going to do its thing. But what is the use of unstructured data? Can I use that? Yes, the advanced AI can be very helpful in that particular case. Okay, so the use case is, if you have unstructured data, you can still analyze it using the advanced data. So these are the core benefits. What are the key risks? Well, obviously, operational risk, right? You're operating AI. So there's going to be cyber risk, which is a major concern. Like, naturally, what we think of the risk, right? Cyber security, cyber attacks. Market could be manipulated using AI softwares. It can be manipulated as well. There's going to be lack of transparency because we don't know the output that the AI gives. How do we know that, how it generated those outputs? We don't know that, right? So there's naturally a black box output that we really do not know what or how it said this particular thing. So the model is very much opaque, opacity, less transparent, right? So these are the key risk that we have. Model errors is one of the things. Increased volatility from rapid trading. Now we're going to be talking about the algorithmic trading as well. So when we talk about the algo trading, of course we are doing trading in milliseconds, right? But again, same thing can increase volatility as well. It can impact prices go up, down suddenly like that. So there's going to be a price jump that is not expected. Cybersecurity and so on and so forth. So these are the key benefits and key risk that if you implement the AI, what's going to be the benefit and the risk. Now, what are the key applications of AI in capital markets? How can you use that? Well, the very key processes that I'm going to be using in the AI is four things mentioned here. The first is I can use it for my client or institutional. If I want to verify that, I can profile it. I can use it for profiling, better profiling, right? KYC and everything. Identification and needs and what are the constraints. I can go ahead, I can identify all these things. So that is client profiling or institution profiling. That's my very first task. Then I can use, after I have my client onboarded, I can allocate, like how much money should I allocate in different asset class. So I can use the AI for asset class allocation. I can use it for which sector to put my money into. And then, of course, which security apart from the sector, what specific security I should be putting my money on. Okay, so that's a natural progression, as you can see. And of course, once I've decided where to put my money, can I trade it? Can I put the orders? Yes, you can put the orders or you can place the orders via AI. So you can have it for placement of your orders, buy, sell, limit orders, any orders, and execute your trade. Okay, so I did my profiling of the client. I figured out where to put my money, right? Asset allocation, how to trade. Can I manage the risk? Yes. So the natural progression to it is monitoring, right? So you can use it for risk monitoring as well, which is risk monitoring and reporting. Okay, so this particular diagram actually naturally flows to the overall thing, so you don't have to remember it for the exam. Okay, so this is, you just look at it visually, you'd be good to go. Now, when we talk about AI adoption, let me tell you that AI in finance is not new. It had been for almost decades, and we all, if you're working in finance perhaps, or if you're using or investing in markets, probably you might have used or come across a robo advisor, like an app or something which tells you about where to put your money, which stock is doing well, which sector is doing well, so on and so forth. So suggestions as to investments are given by the robots, and these are known as robo advisor. So it's like a personal advisor to me, but it's AI. And there is also AI driven ETFs that also exist. Okay, the exchange traded funds, but it's managed by ETFs. Okay, However, for the exam, what you need to remember is that robo advisory is more popular, and the assets that a robot is managing is significantly higher as compared to the AI powered ETFs. But ETFs driven by AI is still, it's still growing, right? It is still growing. So that is something that you just need to know for the exam. Now, what is the role of generative AI? Let's welcome generative AI. As I said, Gen AI or generative AI, it helps you that you are like interacting with the AI, but with a prompt. It's like you are running that particular ship. So you give the direction, okay, give me, generate me an image for this, generate text, summary, anything, right? So the perfect example is the chat gpt, claude, and all the other AI that are making in the news, right? I mean, they are generative AI. You can use them to generate outputs based on your prompts. So generative AI is building on existing models by improving investment idea generation, right? If you have any investment, it improves upon it. Coding efficiency has been improved. We know that it can code a website in just few minutes. Client facing processes, right? There's AI, there's robots, that IVR, a lot of things. So LLMs are increasingly used for forecasting and analytics as well. And in the next chapter, we'll try to understand that why companies, why companies are using AI, why they are implementing AI, because of the competition, because of the fear of missing out, and so other points that we have in the next chapter. But yes, LLMs are being implemented in companies. Now, while AI can potentially lower entry barriers and speed up market reactions, you can purchase that, right? It's like 2,000 rupees per month to use that AI. A human in the loop approach. Now, this is an important point. Okay, I've highlighted here. We are using AI, right? Robo advisors, a lot of things, but essentially the main point here is that a human in the loop should be there. A human judgment is more critical. That is what this point is suggesting. Okay, why? To manage regulations and ethical decisions. That is why a human should be there, even though we are, implementing the generative AI in financial systems. Now, what are the emerging trends? Is there any emerging trends? Yes, AI adoption is strongest in liquid market. So if you look at the liquidity for a particular product, right? All the commodities like segment, let's say equities, bonds, foreign exchange, real estate, infrastructure, everything, right? If you look at the liquidity score, you realize that equities being the highest liquid, foreign exchange the second one, and bonds the third one, these are the areas where AI are being implemented a lot, right? Why? Because the system can learn quickly from the dynamic data. The more liquid, the more activity. The more activity, the more data. The more data, the better the AI, right? So that's the overall thought process. At the same time, this is also important, high infrastructure and talent. You need that, server, that GPUs, and the infrastructure to run that particular AI. And of course, the people, you need people so that they can understand the output, they can use that thing, right? uh, that's talent is really important in this particular case. So there are only few who can have this kind of a, or they are into this particular game right now. And of course, the talented people, they all hire the talented people in the team. So this may lead to market concentration. So this is one point that we need to know for the exam. And this, of course, favors large data rich firms. So the people who have large data, they are being favored. Okay. Now, what are the AI applications? Now, I've highlighted here that what are the use cases? Okay, I'll show you the diagram. Probably you'll be able to remember that. So there are certain AI applications that span a broad range of use cases. Okay, you can have it for development or forward-looking indicators, integration of alternative data sets, extraction of trading signals, portfolio allocation, and optimization. I think the better thing here, quickly, I'll let you know what we have referred so far. So see, I'm going to be very quick, right? Since this is a crash course, so you can see the robo advisor, you can see the growth. It is almost exponential, right? It is growing like anything. The robo advisors asset under management, and then, as I was saying, that the higher the liquidity score, the more adoption of AI. For the very simple reason, more activity, more data, and better outputs. So if you look at it, the equities, commodities, fixed income, they are in the highest liquidity score, and hence you see the opportunities of AI is also on the top. Right, that's one thing that we need to know. So if you want, you can download this from the GARP website and you can refer it for yourself. Uh, I was talking about the use of AI, right? So this is the use of AI. Alternative data set. Yes, we want to work with alternative data set like pseudo random number generators. What if I have some other data? So for that, the majority of the time the AI is used for creating alternative data. Then second is forward looking indicators. What's going to happen in the forward? I mean, of course, what would the investment managers use it for? To have data, to see what's going to happen in the future, analyze the market indicators, generate new investment ideas. Now here is this thing that why I brought you to this particular thing. That is executing investment decisions. No, almost 60% you realize that no, we do not plan to integrate. Otherwise, what would the manager do? So execution, it's going to be done by the investment managers. They do not plan to use AI in it. And then, of course, allocating, deciding where to put, it's fine. Allocating, executing that, again, they do not plan to use that. So maybe this image will help you to, remember this thing for the exam. Okay, so these are the use cases. I've just gone through that in that particular image. Okay, now what are the benefits of AI? Very quickly, efficiency, better data processing, yes. Lower trading cost, yes. Because why lower trading cost? Because the bid and the ask. See, when there's something illiquid, you can demand any money, right? Ideally, we say that there's no MRP to it. There's no fixed price to it, right? But when you have multiple transactions going on, when you have a lot of transaction going on, in that situation, what happens is there's a lot of buy and sell happening. When there's a lot of buy and sell happening, you actually determine the price, and that price discovery is also one of the benefits of AI, right? There's a lot of people are buying at this price, a lot of people are selling at this price. So overall, that's one of the core benefits of AI. And that is reason, because of more buy and selling, the liquidity goes up. And if liquidity goes up, the bid and the ask, they fall down. The spread, basically, it falls down. So there's a narrower spread, and hence the trading cost also goes down. Improved forecasting, yes, the accuracy is pretty much better. AI is used in the asset management industry. Yes, it is being used. AI supports decisions. Again, here I've written it in the bracket. It does not replace humans. It helps you to make a decision. Okay, remember that. Humans, however, they still take the final calls. It is fully autonomous trading, still limited. That okay, I just put a it takes access to my broking account and it does trading on its own. Okay, we'll talk about the negatives of that, but still it is very, very limited. AI mainly feeds into the existing models. Okay, what existing, it builds upon that. That is what the thing here is. Regulation benefit, yes. Regulation benefit is of twofold. One is of the supervisors, for example, central banks. Even they need to manage the financial stability, right? That's their core responsibility. So, what do they use any kind of a tech or AI or something? Yes, that is known as supervisor tech, also known as the soup tech, which is used by regulators. Why? To monitor, to monitor banks, to monitor data, to monitor transactions, right? And if effectively for detecting any anomaly found in the regulation or in the regulation things, right? So that is what soup tech is used for. Then we have a reg tech. Reg tech is a regulation tech which is used by firms, banks. Why? For compliance purposes, specifically related to the regulation. Okay, so that is being used. So these are the regulation benefits of AI, apart from having it in the capital markets. So overall, these help improve surveillance and oversight of the risk that is there or it might develop. Now, of course, AI will increasingly drive investment and trading decisions, as we said, but human in the loop still remains critical. The growing number of AI related patents. Now, this is also important. This clearly proves that higher number of patents that is being registered, more innovation is being done, right? And obviously, you will register patent which is innovating, right? Which has a breakthrough kind of a product. So the number of patents for AI related is also growing, particularly in high frequency trading like algorithmic trading and asset management functions like rebalancing the portfolio, forecasting and valuation. So these are the use in asset management plus in algo trading, along with expanding use of alternative data and new asset class. So the same diagram, you just remember that. Overall, AI adoption will deepen, but decisions will still be guided by humans. As I said, this report, you don't have to go through it, but these diagrams, even if you just look at it, probably you'll retain a lot of things. Okay, so you can find this in the GARP website. So these are the number of patents that has been done specifically for high frequency, and this is for the asset allocation or in the asset management. And you notice that yes, it is increasing, it is going up. So that's a good sign of innovation. What are the broader implications? What are the broader implications? Demand for AI is rising. Yes, demand is rising, and hence you would see that on LinkedIn, roles that are linked to trading and investment are also rising. So people who have skills that are related to AI, they are more in demand as compared to the others. Okay, AI support emerging markets by improving, of course, it provides more liquidity, capital access, and financial services, with Gen AI structuring unorganized data, and sometimes it can create synthetic data, right? You may need synthetic data, which we will talk about in the next chapter. So you need these things. However, if you look at the broader implications, we talked about the opportunities, right? People are, if you go to LinkedIn, you'll see a lot of people, they write AI as one of the skill set. So that demand is rising. That clearly shows that. So demand for AI talent is rising. Having said that, what are the implications? Well, there's going to be a biasness, misrepresentation, deep fake, all the manipulation, right? These are the risks that at a broad level you would see that. Despite some job automation, there's going to be some automating of job. AI, however, is expected to enhance financial inclusion and reduce barriers to entry across markets. So overall, the benefit is higher. That's what this is communicating. Next learning objective: implications of further adoption of AI on market dynamics. Now, what I've done here is that I've underlined, you just need to remember the underlying thing for the exam, you'd be good to go. So when you adopt AI, and what are the shifts that are happening in the market structure? Very well, I would say that the shift is that the very first shift that you need to remember is that of a bank versus NBFCs or non-banking financial institutions, right? So what is happening is bank, by the very nature of their business, they are highly regulated, right? They have regulations, they have to comply to all those regulations. But NBFCs or non-banking financial institutions, they comparatively they do not have much regulations, right? And hence these are the segment, the NBFIs are the segment that can have maximum adoption of AI into their systems. Okay, so AI is reshaping capital markets. NBFIs, which hold over half of global financial assets, are better positioned to benefit from AI compared to traditional banks. So that's one shift in the market that we are seeing. And secondly, algorithmic trading is a key driver. Now, remember this thing: 70% of equities, 50% of futures, more than 40% of options are trading in the US are being adopted by algorithms. That means 70% of equity trading, buy and sell, is done by algorithms. That's an interesting fact, right? So that is what we have it here. But the only thing is that we spoke about liquidity, right? And we realized that fixed income is a liquid asset. Agreed. It can be adopted, right? AI can be adopted to this particular segment. However, there's only less than 10% of algorithms that is being implemented in the fixed income segment. Why? Okay, because of certain restrictions. Okay, it's not every day that that is being happening. Hence, this clearly shows that uneven adoption. We are talking about adoption of AI. That's uneven. That's what we need to remember. Overall, high AI costs are increasing market concentration. Smaller firms, we have to rely on larger firms to use their AI. And that's again a chapter in the next, a topic in the next chapter that we have. So the adoption and the shift in the market segment. Now we are talking about the algorithmic trading and market implications. Of course, market has improved efficiency, liquidity, everything is improved. We agree to it. But this happens in a normal conditions where everything is fine. This thing happens. Better productivity, liquidity, everything. But you know what? In stress time, liquidity can dry up. Why? Because the high frequency traders, they know that okay, it's going to be illiquid. So what they do is they are out of the market. They're not selling. They're not buying. So the if they're not selling, then who will buy? If they're not buying, I'll not be able to sell. So these high frequency traders, informed traders, they are out of the market during stress time, and hence the liquidity can decline. And this leads to higher volatility overall in the market. So if you implement algorithmic trading, remember I said 70% of the equities are being, done by algorithms in the US. But what are the implications if this is happening? So the market can be disrupted due to less liquidity. There's also a price behavior in the good times. As I said, as more trading can help you find or discover the prices in the market, right? More liquidity, everything. But in stress time, there's going to be a price swing in illiquid or stress environment. It can suddenly jump up. There's no trader, there's no buyer, there's no seller. So you have to accept, you become a price taker. That's what the point here is. Market stability. Can algorithms affect the market stability? Yes. So there are certain risk controls such as automatic shutdown of the market for some time, trading limit that okay, above this you cannot trade. So these are controls, right? essentially to protect the stability of the market. However, during the stress time, these same triggers can actually trigger feedback loops. Like, for example, if what is a feedback loop? If there's a sell recommendation from one AI, the other one will also say sell. The other one will also say sell. Looking at the falling markets, more AI will respond to it. Okay, sell. So the loop is getting created here. So that's known as a feedback loop. And of course, this will drain whatever liquidity that is there. And what happens? People then move to flight liquidity under stress. They move to safer investment, gold, bonds, right? Safe investments. Where high frequency trader, they step back, order cancellations decline. And then what happens? This is also important. That's why I'm going through it. Institutional investors somehow they get into the field. They rely on hidden orders to minimize market impact. So what these institutional investors do is that they whatever hidden orders they've placed, they will become the market maker. They try to become the market maker, and they try to provide liquidity to the market. That's what they actually do it. So no matter if it's good, you can have algorithmic trading, improves market efficiency, price, and everything. But these it can also destabilize the market, and that's what the point here is. And finally, what is the impact of Gen AI? Gen AI can further transform algorithmic trading by lower barriers to entry. So there's less entry to it. It also enables better processing or complex text based data and support more standardized and scalable across. So this is a good point actually. Just read through it, you'd be good to go. So what are the potential impact of adoption of AI? What are the positives? It increases the stability, right? Uh, it could operate in a there's less flash crash risk. What is a flash crash? I'll just explain this. So, for example, if one AI says that okay, sell all if everyone is using the same AI, let's say I'm using ChatGPT, you all are using ChatGPT, right? We say that okay, uh, this particular stock, what to do it. So what if IBM, let's say that, then it says that okay, buy, or let's say it says a sell. That if one is it gave me the response of sell. So of course you will sell, I will sell, everyone will keep on selling, and that effectively is a crash of the price, and that too in an instant. If it is algorithmic trading, I mean algorithms, it in an instant it can sell, right? So there's going to be a flash crash risk. But again, that's a positive scenario we are talking about. It reduces that, the algorithms. However, it if you look at the negative, the other aspect to it, AI magnifies existing risk related to the algorithms. For example, it can expand algorithm to a broader set of assets and different geography areas, different countries, and so on and so forth. This could exacerbate risk not just in one location, but in multiple location. A broader systemic risk is what we are saying as a negative scenario of the market liquidity. Okay, that's the positive and the negative. What about the leverage? Well, AI improves the management of leverage. Of course, you can use more. If you have an arbitrage opportunity, you can use AI to, to use more leverage. It will uh, obviously if you want to do arbitrage you need to have leverage. Without leverage your profits will be very minimal. So it improves the overall leverage. AI could facilitate more frequent and automated management of leveraged positions based on more inputs. But again, the more leverage that you need for these trades, that can actually be a negative outcome. That is what we are talking about. Okay, it can help you manage that, but it can help you to take more and more leverage. That is what we are saying. Interconnectedness. AI increases interconnected, right? It can reach to multiple asset class, different geographies, different trading venues, right? And so on and so forth. But this increased interconnectedness lead to higher correlations among assets. That's a negative. On the positive side, all the markets are getting better, better, effective, liquidity, everything is getting better. overall across many geographies or trading products. That's the interconnected positive and the negative. Emerging market dynamics and financial stability risk. Now, what are new? Any emerging market dynamics? Yes, faster market reaction to news. This is a new thing, right? Essentially, what is happening is AI will help you to analyze quicker and more accurate interpretation of information. So any news that is being shown in the TV or anywhere, right, it can help you to analyze it very quicker. So that's the emerging dynamics of the market. It can help you to trade more, but it can be pro cyclical as well. For example, AI driven strategies adjust portfolios rapidly, right? That leads to high turnover. Of course, buy, sell, buy, sell, buy, sell. Yeah, it goes on and on and on. This supports price discovery. As I said, it helps you to find that accurate price for the product in stable markets. But it can be negative that it can amplify volatility during stress. It can be price jumping during stressful times. That's one of the things emerging in the market. Potential for AI driven manipulation or collusion. Interactions between algorithm may create mispricing or strategic advantages. Now, as I said, sometimes what happens is we need to understand collusion here, which is the same as manipulation of AI. That means all the different algorithms, let's say, as an example, ChatGPT, Claude, Gemini, and so on and so forth, right? They all these AI, they start to interact with each other and they give you that same output. Unknowingly, I'm saying unknowingly, they start to interact with each other. That and they in order to have that uh, you know unintended or basically to manipulate, right? So that is a risk of collusion. That means algorithms interact with each other and in such a way that it produces a negative outcome. That is what the potential for AI driven manipulation or collusion actually means. So these are the dynamics that it can happen in the market. Moving on to the next learning objective, explain the implications of further adoption of AI on financial stability. Now, overall financial stability. Now, think about it. What's going to happen is that if we all implement AI, okay, in financial stability, what's going to happen is that very quickly the herding. So if you look at this, remember this, okay? Herding and market will be concentrated. Few providers, few AI softwares, right? Of course, there's going to be herding. Everyone will think the same. So the very key risk is herding and market concentration. People will take same decision, same stock, same outcome. That's one of the major risk. Second is vendors are very less. I want to purchase AI. Where do I go? I only know few AI softwares, right? So the vendors are concentrated. Cloud computing providers, there are very few. AWS, Azure, right? So there's a concentration. So these are the risk associated with generative AI if we implement that in the financial system. There is market is fragile. It can go up or it can do better in good times, but in stressful situations it can go wrong. It can be manipulated. So market is very fragile. That's what the point is. And fourth is the cyber risk. We all know deep fakes and social media content that can be misleading, so on and so forth. And the tiny risk here is that of the job replacement. So these are the core risk that we have it here. And what are the other risk? Of course, the model is not able to explain it properly. The black box theory, hallucinations. It gives you outputs confidently, but an incorrect one. High cost to implement the AI, unauthorized data can be used, privacy risk, reputational risk, and emerging market fragmentation. It can move to emerging markets which is not meant for it. Okay, it could happen that as well. Okay, so that's what this particular point is. uh, Concentration trading strategies rely on similar open source model, right? Open source AI. This creates vendor concentration. AI driven markets may face excess volatility, flash crash, cyber risk, illiquidity, and data poisoning. So that is one of the market fragility. Also, there is shortage of skilled professionals to manage such systems effectively. So that's again, market is very fragile. Model hallucinations, market manipulation, and high fixed costs. So these are the core impact of AI on financial stability. And of course, we said about the cyber risk, they are more significant because this can erode confidence in the market and trigger market instability. Okay, so that's the cyber risk. Now, what the regulators are doing, we talked about AI implications and everything. What are the response of the regulators? Well, survey participants, 27 survey participants, what do they expect? They expect regulators to provide clear guidance on AI risk management, including transparency, any disclosures, and extreme scenario stress testing. Obviously, banks do stress testing, so we'll do stress testing for AI, extreme one. Transparency, any disclosures that we need to understand. Clear guidance is required from the regulators. That's they expect. There's a strong emphasis on accountability frameworks and balanced regulation that supports innovation while ensuring consumer protection. So that's what they expect, right? What are the financial stability challenges? See, look at the challenges, understand the challenges. First, what do you think of it? Cyber risk, very common. Market manipulation. AI increases cyber threat, data breaches. So that's one of the key challenge. Operational risk, because we are using cloud service providers, we are using someone else's service, right? So what if something happens on that particular provider? That's going to be an operational risk from third party dependence. Monitoring and opacity, right? It is opaque. AI is opaque. You really don't know what's happening or why has the AI given me this particular output. We don't know the why for it. So there's a monitoring and opacity challenges specifically to the industry that is adopting, which is the non-banking financial institutions. They themselves have lower regulatory requirements. They disclose less comparatively as compared to the bank. So when we look at certain industry like NBFIs which are adopting AI, how can we expect or how do we monitor their challenges? We don't know that. So that's again a challenge in itself. And of course, higher volatility and market speed under stress. AI improves efficiency, good price discovery, everything. But as I said, it can amplify volatility, flash crash risk, everything, right? Rapid sell off. And people will move to safety like other products. Again, same thing. Overall, as I said, if you remember the main core points, you'd be good to go for the exam. The next learning objective, describe best practices for regulators now pertaining to the AI. So, regulators and supervisory scope. This is what the best practices here is mentioned. Regulators are expected to stay proactive. They're expected to stay proactive. Okay. Supervisor must build capabilities to process these data sets, monitor complex strategies of the banks and everything. That's their first expectation. What are the role of global regulators, bodies such as the FSB, Basel Bank, BIS, and all the other bodies? What they are doing is they are strengthening frameworks. They're creating those frameworks and they're strengthening that. That's a good thing. That's a good thing. To enhance investor protection, market integrity, and financial stability. Okay, so that's what the global bodies are doing. Then policy direction. When it comes to policies, safe AI adoption requires evaluating current regulations, develop new, and promote governance standards. That is what the policy is expected, or the best practice is. And is there any supervisory benefits of AI? AI enables efficiency gains through automated. So yes, even supervisors, they get benefit of the AI as well. Okay, policy recommendations now. Again, same thing, it is being repeated here as well. The same challenges, but in a different way. So this is important thing, and you need to know for the exam. What are the key priorities that we need to address? We are adopting AI in the capital markets, everything. What are the key priorities? Very first one is regulator may need to redesign or enhance tools like circuit breakers, test. See, essentially what is happening is that we know that, okay, there is, under the stress time, there's high volatility. The market speeds is also very high due to algorithms and everything, right? But having said that, what the regulator is supposed to do, the regulator is supposed to test circuit breakers. If you don't know circuit breaker, a circuit breaker is there's an upper circuit, there's a lower circuit, so on and so forth. So if that is breached, what's going to be the maximum low point or maximum high point, right? That is something that you need to test. You need to test trading algorithms, the algorithms that are used for trading strategies. For in both normal situations, stress conditions, you need to stress test that. Okay, that is what regulator is supposed to do, or the key priorities as to what we are suggesting. Reassess margin frameworks. See, in good times, the margins are pretty much less, but in stressful times, there could be higher margins, higher collateral requirements. So we need to reassess margin requirements as per these high speed trading, right? That's what the core priority here is. So that's the first one. The second one is operational risk from third party. Heavy reliance on few providers creates vulnerability of the entire system. So regulators, what should they do? They should map these interconnections and strengthen cyber resilience, ensuring system can prevent, withstand, and recover from attacks. Not just, okay, it can analyze it. No, it should prevent. That's a priority. It should prevent, withstand, and recover from these attacks. That is what is expected from the regulators. Opacity. How do you handle the less transparency of AI and monitoring? See, okay, financial institution must map interdependency, right? That's right. Risk arise when data is incomplete. We don't know what that, how the outcome is. It does not cover full financial cycle. So maybe you got an output from an AI to buy, let's say, a company ABC, and this, the AI has given this output based on the data from 2010 till 2019. Now, is this a good recommendation? We don't know. Why? Because the AI has not taken into consideration the 2020 COVID times. So it has not covered the full financial cycle. And that perhaps could be a challenging thing, because this might be a biased. Okay, we know that AI doesn't know that. It is giving you probably the right output, but we know that it has not covered the entire financial cycle, and hence this might not be the best recommendation provided by the AI. Okay. Uh, so regulators should require NBFCs to, or NBFIs to disclose more AI usage. If they are using this, disclose it to the regulators. That's what the key priority here is. They should strengthen the liquidity buffers, risk management to reduce the liquidity runs, and mispricing. Fair enough. And then finally, in the OTC space, is there any priority? Yes. OTC markets need stronger resilience and oversight, as if they adopt the AI, right, they're unregulated, right? So what is expected, regulators may require more, you know uh, detailed transaction reporting, and consider policies such as improved liquidity framework, more use of central clearing so that they come under the purview of the exchanges, basically. Stronger market making support and margin requirements for the OTC trade, that is what is expected, or the key priorities in terms of the OTC sector if they adopt more of AI. So that is what we have it for this particular chapter. Give it a good read. Okay, not something that you really have to stress about it. Use these diagrams wherever necessary. Do not go too much into it. As I said, no need to go ahead and use that. These are the key areas, right, where the regulators are expected to governance, transparency, explainability, need for human in loop, reporting requirements, data quality and bias, and outsourcing. So these are the key areas that they are expected, the regulators are expected to work. Okay. So that is it for this particular chapter. Let's move to the next chapter. Okay, reading number 101, the financial stability implications of artificial intelligence. Now, whatever that we have studied in the previous chapter in the AI, okay, a lot of things that we have seen might be repetitive here, okay, but it's going to be interesting overall. So, what are the key developments of AI since 2017? If you look at the overview of recent AI developments, AI has been in the use in the financial services for years, but the adoption has accelerated due to the recent technological advancements. Now, AI spans into the operations, right? If you are doing creating a model for model risk management, capital optimization, customer interactions, right? Chatbots, credit scoring, portfolio management, trading, regulators, subtech, regtech, all these things. So it has adopted in these different areas. Generative AI has further expanded capabilities in areas such as document processing, fraud detection, customer support, market analysis, repetitive stuff, right? While these developments create efficiency, they also introduce new risk and vulnerabilities. That is something that we'll talk later as well. Now, since the Financial Stability Board, which is there in the UK, the report in 2070, advancements in big data, deep learning, and computing, along with launch of ChatGPT, have significantly accelerated the AI adoption. So it just talks about how the overall the AI has been adopted. But there are two broad reasons as to why AI is being adopted. One is the supply side, that new and new AI is coming into the market. You're right. That's one of the reasons. And the other reason is that of a demand, that people need it, companies need it. Why? What are the reasons? We'll talk about that. Starting with the supply side. Okay. Obviously, new and new technologies are coming up. So new models are being created. It's new AIs are being thrown in the market, right? So advancements in both hardware and software have played a key role in the AI adoption. More and more technology is coming up. So improved processing of unstructured data, you are using AI. Emergence of transformer architecture enabling large language models, something that can transform architecture. It can transform text into images. All these transformer architecture is what we are. So new and new transform things are happening. You put a text, it can generate an image for you. Increase computational power, that also has increased the supply of these AI, allowing larger data set and more complex models at lower cost. So these are the reasons why the AI has come to the market. right? It has more supplied to the market. But there's one constraint. So I've highlighted the constraint. What is that? Shortage of skilled human capital needed to understand everything. That's one constraint. Making AI talent expensive and difficult to acquire. Okay, so on the supply side, very first reason is technology is good, is providing good, but again, you need more people to understand, and that could be a constraint. The second is data related developments. Obviously, data is everything, right? The rise in digital interactions has led to massive growth in unstructured data. So you need AI for it. So AI systems can now combine traditional structured with sources like images and videos. So it can make sense out of the unstructured data. However, there is a constraint. Most AI models require vast amount of data, which may not always be available. So this is one of the constraint. So what do you use instead of that? You use synthetic data. But if you use synthetic data, that can lead, you're not sure about the quality of that artificial data or the model reliability. Okay, that's one of the challenges here. Business model developments, that's one of the third reason for the supply side, why the supply of AI is increasing. Business is getting developed. Cloud computing, pre-trained models have transformed how firms adopt AI. Firms rely on cloud providers. Okay, there are, as I said, AWS, Azure, these are the core cloud providers, right? So pre-trained models, they give us a pre-trained models, so you don't have to build starting from scratch or new, right? You already have the model, use it. Open source model, something that is free to use, open source, anyone can go ahead and they can use that, are gaining popularity due to flexibility. So because of these reasons, there's a supply, increased supply of AI, right? Firms are using these providers, they are able to scale their operations cost effective. But what are the constraints to business model developments that is happening? These reduce cost and time, but they also create challenges related to accountability and explainability. I'm using this open source model. I don't know why the output is why. I mean, why it has shown me that particular thing. The accountability, who will take that accountability of the decisions? Nothing, right? So, and I'm dependent upon these firms to provide me this cloud based services. So I'm dependent upon those vendors. So that's one of the constraint that we have. We spoke about the supply side, that okay, technology is getting better, data requirements is getting improved, model is business model is being developed in a better way. But what are the demand side? Why companies want AI? Why do they want it? Well, profits. Very first reason is profits. They want better revenue through better effective productivity is the overall name here. Better personalization, onboarding of the customer, lower churn rate, right? So overall, if you look at it, profits, high profits is one of the demanding reason for the companies. Cost reduction, of course, you increase profit by reducing the cost. Automation, productivity gains, improved risk management through better forecasting of cash flows, losses, and delinquencies. So you can use AI for these risk management activities as well. What about competition? Fear of falling behind peers, FOMO, right? Fear of missing out. What if the competitors go ahead, right? So that is why people are adopting faster AI into their processes. The companies are doing that. But this could be a good thing. Yes, you efficiency goes up, cost is less. These are positives, but there could also be negatives. Like, for example, if you're rushing to implement it, right, without proper knowing things or without proper safeguards, this could be a challenging or the negative aspect of the competition, right? Regulation, of course, Firms are using AI to improve compliance efficiency as to stay more in a better way, or into to stay more advanced is what we can call it. Firms are using AI to improve compliance efficiency as data protection rules, guidance on AI, and international standards expand. Because of more regulation, you need to use AI. So these are the demand reasons. Okay, identify and analyze existing use case. Which industries should you use the AI? So we're going to be talking about the industry use cases where you can use this. So there are four areas. One is the customer centric area, customer client facing, you're using the AI. Second is on the operations, admin. Third is on the trading. And the fourth one is a portfolio management and regulations. Customer focused. Why should you use AI in the customer facing, customer focus? Obviously, on the customer side, I have it here. On the customer side, it helps bank assess credit worthiness, improve pre-loan. You get a message, right? The loan is pre-approved, so on and so forth. Personalize marketing for their campaigns and everything. Personalized marketing, matching advisors with clients. You have a you can get the client to a particular advisor of what is needed. So when you use these AI in all these activities, it will enhance the overall customer experience. That is what the point here is. It enhance insurance price and risk assessment. Even for insurance pricing and risk assessment, it can be used. Whether the customer is eligible for a policy or for the insurance, it can be useful for that as well. Gen AI has also made chatbots far more advanced through LLM based interaction. So you can use these things in the customer centric thing. What about the operations focused? In operations back office, can we use AI? Yes. It supports model risk management. A few things here that that probably you might have to just go through it once or twice, but just go through it, okay? AI supports model risk management, capital optimization, codes. We all know it can generate code. It can analyze the market, the impact of the market, volatility liquidity risk management overall. How to optimize the capital, where to put the money, where to invest, sector wise, so on and so forth. It can help us. Gen AI has further expanded this by improving search results, content creation, legacy code modernization, all the legacy softwares. It is trying to modernize that. So we have recently seen for the Claude as well, right? The IBM COBOL software. Transcription, it can transcript the data, access to advanced tools with limited technical staff. So that's why this can be useful. Trading and portfolio, yes, Gen AI help with trade execution, market analysis, automation of investment analysis, and decision making. This deserves just a good read, okay? Regulatory compliance. AI has become a key reg tech tool for fraud detection, anti money laundering, the financial transactions, sanctions, monitoring, tax evasion, all the negative aspect for regulatory compliance. Basically, it can be used as well. So these are the broad areas for the industry use case, right? Even in the regulatory and supervisory, do you have a detailed one? Yes. Soup tech or supervisor tech is again central banks using AI for data collection analysis. Same thing that we have seen in the previous chapter. In supervision, AI helps review large documents, draft inspection reports, automate their workflows. This is important, okay? This is interesting, I would say that. Going forward, Gen AI is maybe used for stress testing and simulating bank runs for the regulator. This could be a very interesting use case for the regulators. Okay, moving on to the next learning objective, assess the potential implication of AI for financial stability. Now, what happens is that, okay, we are talking about AI, adopting it, and what risk or implications it can have for overall financial stability. There are few pointers that has been mentioned regards to third party dependency, concentration, so on and so forth. Financial institutions increasingly see what happens on third party dependency, understand as a whole, like what is happening here. There are few providers, as I said, AWS, Azure, these are the cloud providers. ChatGPT, Gemini, Claude, these are few AI tools that we know. What we are doing is, if I, as a bank, if I am dependent upon a particular cloud vendor, cloud AI, cloud service provider, then I am essentially dependent upon this. Anything happens to this cloud server or this AI, I will be impacted. That dependence is one of the potential implications of AI for financial stability. So, what is a third party dependence and concentration? Financial institutions increasingly rely on cloud providers and external vendors for their AI capabilities. Now, what happens? This creates concentration risks, as there are only few providers who will dominate this particular sector. So, anything happens to them, the bank will be, will face that effect. So, what are the drivers of concentration? Why this concentration happens? Well, obviously, high cost and complexity of AI. It's not I can create my own AI. I need huge amount of data, huge amount of time, huge amount of resources. That is why there are few providers. The second reason is vertical integration across the AI supply chain. There's a vertical integration, right? Limited availability of advanced chips. We all know about the GPUs, right? There's limited availability for that. It needs huge amount of computing power and large investments by incumbent firms. Companies have put lot of money. So that is why uh, uh, some firms are going all in. So that is why these are the drivers of concentration in the AI service providers. However, some factors may reduce concentration over time. Okay, as we move across time, the concentration will reduce. Why? Because of growth in open source model. Earlier we had ChatGPT, Gemini, Claude, this AI, Perplexity, this, that, so on and so forth. See, whenever there is a growth happening, the dependence on one specific provider reduces. That's one thing. Increased competition among the providers. That's again second reason. Development of domain specific AI models. So there are AI models that deals only in finance. There are AI models that are used for websites, for marketing, so on and so forth. So these are some of the factors that can lead to less concentration among service providers. Overall, reliance on third party exposes firms to operational, cyber, and supply chain disruptions. Okay, that's all that we need to remember for third party correlation dependence. Market correlation. What do you mean by market correlation, which is a second potential implication of AI? Think about it. AI driven decision making can increase correlations. As I said, if I'm using ChatGPT or if I'm using Gemini, right? Any software, any AI that I'm using, if they both the algorithms, if they both interact, that it can collude, right? That's what collusion is. Or we can say that basically they provide similar results. They are saying to buy IBM. Gemini is also saying to buy IBM. So basically the point what is happening is this kind of thing, it creates a herding concentrated behavior where multiple participants react in the same way. This is a good thing. Buy. What if it says sell IBM? Sell IBM. What's going to happen? Flash, crash, risk. Okay. So AI driven decision making can increase correlations. If this is giving sell, this might also give sell. Maybe they will learn from it, or they may interact, whatever that thing is, right? Across, if you're using. So that is what the increased correlation thing is. AI can give decisions that rely on similar models, similar data, similar buy, hold, sell signals. This creates herding behavior where multiple participants react in the same way at the same time. What's going to happen? Okay, we are doing that. What's going to happen? What are the risks? Volatility goes up. Synchronized market movements. Everything will become synchronized, in sync. If one is selling, other will also selling. So it follows the pattern. That is one of the key risks. High probability of flash crash, liquidity drain, correlated errors. If models are trained on the similar data set, you will get more of correlate errors will also be correlated. That's the problems with market correlations. We have an example. If multiple funds use similar sentiment based AI models, a negative news could signal trigger simultaneous selling across markets. That can be the market correlations. However, AI can also reduce correlations if used to create different strategies or niche. If something is differentiated, it can reduce correlations. Diversification, basically. And what are the mitigation strategies? Circuit breakers, right? You can implement circuit breakers. If there's flash crash, implement circuit. Trading halts, as I said, risk mitigation, right? Market shutdown. Improved model diversity and transparency. Have more opacity, less opacity. Continuous monitoring of systemic risk indicators. Just monitor it. That's all that we can do it. What about the cyber risk? AI significantly increases the scale and sophistication of cyber threats. Gen AI enables attackers to automate. While now this is an important thing, okay? Just interesting, I would say that. Gen AI, it enables attackers to automate and enhance their attacks, while it lowers entry barriers for less skilled actors. The perfect example is a deep fake. Even someone who does not know how to create that particular video or do that, they can simply go to the AI. The barrier is low, right? The entry barrier is low. Log in, create your account, do that. That's so basically the point is that Gen AI is doing good, but cyber risk it can go up a lot, right? Because anyone can access it. The cost is low to create images, videos, so on and so forth. Key vulnerabilities of cyber risk: prompt injection, that means extracting confidential data and model poisoning, manipulating your training data where the model is being trained. Increased attack vectors due to large data sets and system complexity. If the system is very complex, we will not be able to understand it. Even that is what the point here is, the cyber risk. What are the critical financial entities? If, let's say, central banks, the UPI payment systems, major cloud providers, if these financial entities, if they are being attacked by cyber risk, A lot of bad things can happen, right? So these are especially vulnerable to all these cyber risk. A successful attack on them can lead to operational failure, loss of confidence, and market will be unstable or unstable. Interestingly, this is an irony in itself. While AI strengthens cybersecurity defenses like faster detection, anti-money laundering, automated response, however, malicious actors may benefit more in the short term. This is what you need to remember. This creates an asymmetry in the risk profile of Gen AI in terms of cyber risk. The next thing is the model risk, data, and governance. As AI models become more complex, model risk increases. Yes, of course, if there's more complexity, the risk increases. Challenges. What are the challenges when it comes to this low explainability, right? Same thing. Hallucinations. Here we have hallucinations. Difficulty validating outputs, data quality issues, everything it connects from the last chapter, right? So what can you do to counter this model risk data or governance thing? Of course, strong governance. When we have governance, we want to do it better. What would you do? Strong governance. Data quality check. Model validation if you want to reduce model risk. Performance monitoring, continuous oversight, risk mitigation strategies. All the points that we have it is self-explanatory. What are the other vulnerabilities here? Financial fraud. Yes, it can happen that there could be a financial fraud. Gen AI enables advanced fraud techniques such as deepfake, fake identities, and it can even bypass security systems. So, financial fraud can happen. Fraud may become easier to execute than detect it. Okay, what a statement. Especially as malicious actors adopt AI faster than the regulation or the regulated institutions. So, improving AI literacy, making financial awareness is key to mitigate financial fraud. Disinformation. Yes, AI can amplify misinformation, especially social media, deepfake and all those other things. So this can trigger strong market reactions and create financial instability. These are the other vulnerabilities because of the Gen AI. Misalignment occurs when system optimize profits. See, we are aligning AI to use as much ethically as possible in order to generate profits. No one wants losses, right? But what if the AI it misaligns that profitability is all that we want to do it, no matter what. So it can go against the regulations or ethical standards just in order to maximize the profitability. So misalignment can be a other vulnerability due to this Gen AI. Okay, that leads to collusion, disinformation that can destabilize markets. In the long run, AI increases demand for data, computing, energy while creating uneven regulation across firms. It may also impact inflation, interest rate, jobs, with even high skilled workers would be at risk. Although AI improves efficiency, compliance, it introduces new risk. Regulators, what should they do now? They should focus on closing data gaps, updating the regulatory frameworks, strengthening supervision. This is expected of the regulators. Overall, AI brings strong benefits, but also systemic risk will grow. Okay, so we need to have oversight. All right, so that's what this chapter is all about. So, all right, let's move to the next chapter, and that is going to be reading 102, the global drivers of private credit. Now, this chapter, it talks about the private credit, right? It's a huge market, right? Even if you look at very recently, you search on Google, you'll realize about private market, right? Private credit. So private credit is, in this particular chapter, we are comparing the private credit versus the operations of the banking sector, right? Majorly, it's going to be the comparison of private credit, like how it has grown. And you would realize by the end of the chapter that due to some of the uh, things that banks cannot do, private credit has, it has solved all the things that the banks could not do, perhaps, and that's why it has grown, right? That's what the overall chapter would be all about. Let's go learning objective wise. Describe the structure and characteristics of a private credit funds, as well as some patterns in the growth of this particular asset class. I'll talk about the structure and characteristics, but I think let's first read or go through this particular thing. I'll just zoom in a bit here. Now, essentially, if you look at this particular diagram, you see that the private credit, right, how it functions is that it is providing credit to home, it is providing credit to the companies which are small, medium sized, probably they are already highly leveraged, and they're not able to access it from a regular bank. Okay, maybe they will not get the loan or the credit facility from a bank. And as I said in the very beginning, right, whatever the things that banks could not do, the private credit can actually do that. So these small and medium sized firms, they cannot access the credit facility, so they reach out to the private credit. Now, how do these private credit, where do they get their funds from? Well, these private credit or the end investors, or we call, this is the overall thing, right? Who are the private credit, the investors and everything. So the investors is this particular lot that you see. I'll just highlight here. So this is the investors that we have it in the private credit setup. They can be pension funds, insurance companies, sovereign wealth funds, or maybe retail. Yes, retail. Like, even we can do it with the retail investors. Yes, this is also a point why I'm going through it, because the rise of the retail investors, okay, it is good for private credit to get more returns. But this can be challenging as well. Maybe I don't know how or what strategy or where they have put the money or where they have given loan to the other company. We don't know that, right? So retail investors, by the very nature of limited capacity that we have, probably will not be able to do that kind of a sophisticated due diligence as the other investors can do. But broadly, these are the investors who provide the money. So all these investors, they provide the money, and then you have these funds who are managing this particular private credit. Okay, I'll just, again, I highlight this. So these are the intermediaries, right? You can have a closed end funds, which is what we're going to be talking about in this particular chapter. You can have open ended as well. Okay, and then you have business development companies, BDCs. This is what the core essence of this particular chapter is. And then you have a CLOs or collateralized loan obligations. And of course, banks also, they do participate in this leveraged thing, right? Okay, they do participate as well. And what they do is they collect the money. These are the funds who will have this money and manage this money, and they create these floating rate loans. Make you, okay, the reason I brought this image is that they give a floating rate loans, not a fixed one. The rates will adjust as per the market rate. And in the last learning objective, you'll realize that why floating rate loans are actually for the betterment of private credit. Okay, so if the market rate falls down, it's a best situation for a private credit. So they give floating rate loans, heavy covenants, very heavy restrictions that the company cannot do this, company cannot give out dividends, company cannot pay to their shareholders back, and the degree of control is also very much high. So that's the typical nature of these loans. And of course, they are given to the borrowers. Who are the borrowers here? Small and mid-sized company. That's all that you need to know from this diagram. Let's move ahead to the learning objective. Now it would make absolute sense. Okay, what is the structure and characteristics of private credit funds? Private credit funds, they provide loans directly to borrowers, small and medium ones, and these loans are generally held for their full terms. Private credit funds are usually structured as closed end funds, so the investors, they remain committed for a very long time. In the United States, business development companies, BDCs, I told you, right? Fund of funds, close end funds. BDCs or business development, they make roughly about one fifth of the private credit market. One fifth. Unlike traditional private credit, BDCs are often publicly listed. This is one of the benefits, and designed to appeal more to retail investors. This is where retail investors can invest to BDC and they can give out loans to borrowers. Okay, and these BDCs, they allow earlier redemptions through open-end features. As I told you, it can be open-ended as well. The investor base of these private credit funds is mainly institutional. Who are the people who give money? Investors, institutions. Okay, because they can lock in for a longer period of time. However, retail participation is growing, which could be a cause of concern. Uh, this matters because, see, they may begin to face asset liability mismatch risks similar to those faced by a bank which rely heavily on short term funding. Now, again, banks, why do most of the banks, if you realize, why do they fail? The reason is the asset liability mismatch. They give an asset. What is a liability for a bank? Loans. What is an asset? Deposits. So they take money for a short term and they give out loans for a long term. That's an asset liability mismatch. Same thing is happening in the private credit funds. If a lot of retail participation goes up, essentially, if I want to invest, I can. I want to take out, I can. So that overall thing, my money is not locked in. These early redemptions, right? That can be a bad thing for the private credit funds. But that's their overall structure and characteristics. What are the strategies that the private credit funds typically use? Direct lending. Either they can give direct money to the borrowers directly. You need money, take it. That's one of the core strategies, often with floating rates. See, everything that you read here is covered in this particular diagram. So it would make sense, right? And strong covenants. Then the second structure could be a mezzanine lending, which is a subordinated debt. They become they issue debt, right? And with possible equity upside. They asset based lending. They are loans backed by collateral. You give me the collateral, I'll give you the loan in the private credit funds. Distressed debt investing, buying high risk debt at deep discount. So these are the ways that the private funds or private credit funds, they put in the money towards the borrower's company. And what are the global growth? If you look at the global growth of private credit, yes, look at the growth now. From $0.2 trillion in just private credits in 2 decades, it has grown from 0.2 trillion to 2.5 trillion over just 20 years. That's a massive growth in the private credit segment. Usually we all go to banks, but there's alternative market which is private credit. The US dominates 90%. Okay, while Europe, Canada, and the UK make the rest. The sector is also broadened beyond traditional industries, like for example manufacturing, it is there, technology areas, clean tech, life sciences, yes, they give money to these firms operating in these sectors. So it has grown a lot. What are the portfolio concentration? See, uh, these private credit funds are highly concentrated. Why? Few things. First is the manager who's managing that private credit fund. He may have certain uh, expertise in certain areas. So obviously he's giving out loan, right, at a higher interest rate, and to a highly leveraged company. So of course he wants to be very much sure about it, right? So they have that particular expertise in that area, and only that is there, that is where these private credit funds put their money. So we can pretty much say that the portfolio of these funds, the private credit funds, is very much concentrated. And I told you one of the reasons is the fund managers, they have natural expertise for maybe, let's say, fixed income. So they'll give loans to only fixed income sectors, or maybe manufacturing sector, or tech sector, like that. So there's one, this HHI, this is a concentration index. This is, if anyone has done CFA, in level two, you might realize that Herfindahl-Hirschman index is a kind of index that helps you to measure the concentration of a particular industry. And the private credit funds, when you calculate that particular index, it was considered to be highly concentrated as compared to a bank. Bank give loans to many different industries, but here it is specific as determined by the fund manager. That's one thing that we need to understand. What are the risk here and trade-off? This model creates a clear trade-off. Specialization can generate higher returns. If you specialize in a certain product or a sector, it can give you more returns, of course. It also exposes funds to sector specific downturn. So as I said, the manager prefers to invest in only AI companies, right? They give funds to AI companies. That is good, but you're exposed to only AI risk. Okay. And something happens to that, it's gonna be bad thing. Institutional investors are better able to manage this risk through diversification, whereas retail investors, as I said, it can be problematic for the retail investors because of the high concentration. The next learning objective, and this actually talks about potential drivers of private credit growth. Why the private credit growth has gone up. Think about it. As I said, one of the major reasons is the banking sector efficiency index. This is one of the major reason. As I said in the very beginning, right? If the banking sector, whatever things that the banking sector is not able to do it, they will catch those opportunities. So one of the major reason is the banking sector efficiency, which is what we call as the FI index. Banks often avoid lending to small and medium enterprises due to weak collateral and transparency. The collateral is not weak. For a large company, they can give a lot of collateral, right? But for a small company, they prefer not to give money. This is where the private credit funds step in by offering flexible lending with customized covenants instead of the strict collateral requirement. So this is one of the major reason why the growth of private credit funds have happened over the past 2 decades. The second reason is that of the interest rates. Of course, interest rates. See, as I said, private credit funds, they mostly have floating rates. So if tomorrow the interest rate goes down, their assets and liabilities will behave in a similar fashion. They give loans to people, right? So their liabilities, people will say that, okay, I'm from 14%, will charge you 12%. Okay, so the interest rate has gone down. So the benefit has been passed. At the same time, the interest that they give to all the depositors, investors, they will adjust that as well. So that's an immediate adjustment to their asset. Think about a bank. What does a bank do? Bank will say that, okay, the interest. So I, as a customer, I go there. Okay, I go to the bank. I say that, okay, loans. What I'll do is I'll go to the bank. I'll say that, okay, the RBI has reduced the interest rate. So from 8%, the interest rate is now 7%. So reduce my interest rate. So what the bank will do? They will have to do it. They will reduce it to 7%. So they have reduced the interest on my loan, okay, which is their income. But if you look at the liabilities, right? If you look at the liabilities, what is the liability? Deposits. This, for example, if it is a fixed deposit, can the bank change it? No. They do not have the option to change the fixed deposit if it is locked in for, let's say, 1 year, 2 year, 3 year. So this is a big problem. They adjust the loans, which is the assets, but the liabilities, they cannot adjust that. And due to this reason, any interest rate decrease will, will impact banks because they are not able to adjust due to the fixed rates. But these private credit funds, due to their floating rate loans, they are able to adjust, and hence this this has also, the monetary policy has also given rise to a growth in their overall developments. What about the regulator? Now, if the regulator is very stringent, for the banks, it is right. They have to abide by the capital requirements, stricter oversight. That already reduces the capabilities of a bank. Then what do private credit funds do? They still go ahead and do that, and they give it more flexibility. So regulations is also one of the things that we have it here. What about the corporate leverage? Yes, corporate leverage is also one of the things. If companies are more able to explore debt, if they want to take it, obviously they'll go to the private credit funds and they'll do it, right? So if corporates are themselves want to purchase more debt, they are open to do so. As non-financial firms take on more debt, private credit funds have shown a higher appetite for highly leveraged borrowers. These private credit funds, they're more willing than banks to lend to highly leveraged firms. Now, these are the four reasons. The BIS, so this is the report from the BIS, and what they've done is that they have quantified the impact of these drivers across 45 countries, and they run a regression analysis as to whether the four parameters that we just spoke about, these four parameters, out of which one is statistically significant or not. That's what they have done, the BIS report. I'll show you the report as well. So, this is the regression result that you need to know for the exam. Just give me a minute here. I'll open that particular report from the GARP website. Just give me a minute here. So, you go to the GARP website, and we are talking about the private credit. So these are the required readings. And if you read this particular report, you will see that the BIS, what they did is that they did a, a regression analysis on the four parameters that has led to the growth of private credit, right? And where's that? This. So they ran a regression analysis, and look at the regression analysis here, right? Policy rate, which is the monetary policy. Then you have the financial index. The bank efficiency index is the second point. But the major thing that you would realize is that of a negative correlation. Of course, if the bank is not performing well, PCF will take on the opportunity, right? And you see a strong negative correlation, right? Similarly, you have the policy rate and you see a negative 0.0030. So what does this tells you is that if interest rate goes down, the private credit funds, they go up. That means they make more money because they are able to adjust as per the floating rate. Similarly, if the efficiency goes down, the overall bank efficiency goes down, the private credit funds, they are able to kind of take on more opportunities. So these two variables, if you read through it, it indicates statistical significance at 1%, 5%, 10% level, any confidence level. These two have proven to be statistically significant. Having said that, if you look at the debt, the companies that they are taking, the leverage, right, corporate leverage, this has a very least kind of effect on the growth of private companies. So we cannot clearly say that, but these two are the clear ones, and they are all statistically significant as well. Similarly, if the regulations are very strict for the banks, it does have a small effect on that, not too much. Now, what you need to do is, again, you don't need to read this report. You just need to remember this table that we have. What are the regression result? What does it tell you? All the variables, if you look at it, the bank efficiency FI index, that's one of the top index that we have. It had the negative coefficient, right? Minus 1.68. We don't have to remember the numbers and everything. Just know that out of the four parameters, efficiency index ranked the highest. It had the highest influence. So if banks are not able to lend properly, they will take in their place. That's one of the thing. And if there's an impact of one standard deviation change, like for example, the inefficiency of a bank, it efficiency goes down by one standard deviation, you know, 33% increase in private credit. That means private credit funds will grow by another 33%. The activity will grow by 33%. That's huge. So you can see by the statistical significance as well. Statistically, that the BIS has done that. What about the monetary policy or the policy rate? Yes, it is also a negative, and if there's a 1%, if you look at the standard deviation, if there's a chance of one standard deviation decrease in the rate, what's going to happen? 12% private credit funds will grow. So regulatory, if you look at, there's a positive correlations, right? If there's more strict, the private funds will grow more, right? If the leverage is more, people accept more leverage, private credit funds will grow even further. But however, this has not, it has a minimal impact as per the statistics, right? Regression. And then for regulator strictness, you see that it's a 2 to 4% increase overall. If there's the strictness goes up by one standard deviation, the overall activity in private credit funds, it grows by 2 to 4%. So it has a moderate impact. That's what the point is. So know this table for the exam, you'd be good to go. Okay, compare the private credit loans with the bank loans. Now, this could be a little bit challenging. What I've done here is that I have gone ahead and I've created this particular thing. So, in a nutshell, I'll explain you what has happened, and then everything would make sense. So, what has happened? We try to identify the we are actually comparing the private credit loans with the bank loans. Okay, that's what we are doing. And how we are doing is we are looking into the cost of equity, cost of debt, and the mix of debt. How much is debt in the balance sheet? How much is equity? Combination of that, right? So essentially, we are looking into these aspect, and we are comparing like whether bank is doing better or private credit funds are doing better. That's what we are trying to do. So, if you look at the cost of capital, we are comparing as per the cost of capital. One of the measures that we will use is weighted average cost of capital, which is known as WACC. Now, what does WACC actually tells you? It tells you that what is the cost of equity and what is the cost of debt. I hope that you know the basics of cost of equity. Like, for example, if I purchase a share of a bank, ICICI, HDFC, any bank, I essentially become the shareholder, right? Whatever their profits, I get to have whatever the fractional ownership that I have. So essentially, the WACC is comprises of two things: cost of equity and the cost of debt. Maybe the bank has issued some debt or loans, sorry, the deposits, consider the deposits, right? The cost of debt, the bonds, anything. So when you look at the weighted average cost of capital, right, it is same for the bank I've highlighted here and the business development company or the private credit funds, one and the same thing, right? But if you look at it, this is where things change. For a bank, the weighted average cost of capital, specifically the equity cost, is much higher. Why? Because after the crisis, there was higher regulation, right? Obviously, banks are more regulated. See, will you invest in, let's say, any bank, ABC Bank, HDFC, ICICI, any bank? You want higher returns. That is one thing. Secondly, the banks are regulated, right? The regulators say that investor protection, stakeholder, shareholder protection, all these regulations are there. So naturally, the cost of equity, equity holders, that is much higher for a bank. Compare this with the cost of equity of a private credit funds or a BDC. It is lower. They don't want the private credit funds. They don't want equity. They don't give ownership. They say that okay, we'll issue debt, we'll issue bonds, purchase our bonds, give us money, we'll give it out. That is what they are doing. So essentially, if you look at it, due to this cost of equity being higher, their overall cost of a bank, the WACC, is overall higher than the bank, than the BDC. So which one is making more money? Obviously, if I'm paying, let's say, if I'm cost of equity is, let's say, 8%, and the cost of debt is comparatively it is low because banks issued bonds at a cheap price. Anyone can buy that, right? At a cheap price. So the cost of debt is, let's say, 7%. Good. Okay, fair enough. They just have to give interest and the coupons. On the bank business development company side, if you look at it, the cost of equity is lower, right? uh, but and they intentionally they keep it lower. They do it, they do not give much of ownership, so this equity cost is low and the cost of debt is slightly higher. So their overall cost, if you look at it, the cost is, let's say, equity is 7% and their debt is 7.5%. So overall, who's winning? 7 plus 7.5 is 15.5, and here it is almost 15. Sorry, 14.5. So overall, if you compare, the WACC of BDC is less than the WACC of a bank. Why? The only reason for the exam, the only reason is cost of equity is higher. Cost of equity is higher. And these business development companies, they prefer to issue more debt because understand this was a typical interview question. The cost of debt is always cheaper than equity. If I'm a bank, if I'm a company, if I give bonds, the only thing that I'm liable to pay is principal plus coupons. So that particular cost, I can bear that. But if I give ownership, that becomes more expensive. That is why in interview we say that okay, cost of debt is, yes, it is cheaper than the equity. Okay. So overall, what is the key takeaway? that WACC for a bank, the overall cost for a bank to operate is much higher as compared to the WACC for a business development company. That's all that you need to remember. Why? What is the reason? Because the cost of equity is higher due to more regulation and risk perception, due to more riskiness the bank could be. So cheap deposits keep cost of debt low. Obviously, cheap deposits, right? So overall, they have a funding advantage. Historically, banks do have a funding advantage because they can get deposits very easily. But the cost of equity is much lower, and uses more debt. Intentionally, they use more debt instead of giving out ownership. So overall, they have less WACC if you calculate in due to the leverage mix. Okay, let's read through it, and now hopefully it would make sense. Private credit loans are more flexible and cater to riskier borrowers. We know that. We are comparing the banks versus the private credit in terms of the cost of capital framework. After the 2008 crisis, banks faced a higher cost of equity due to regulation and risk. Even though BDCs have a slightly higher cost of debt than banks, debt is still cheaper. Okay, it's always makes sense to issue more debt as compared to equity. You have to pay for a fixed maturity, and then after that, the company is yours. Over time, this reduced the funding advantage that banks historically had because this got expensive for the bank. You know, the business development companies or private, they started to exploit that advantage. As BDCs lowered their cost of capital, overall WACC, they could offer more competitive loan pricing, leading to further growth of private credit market. Now, the main drivers of this growth were lower cost of equity, which I've mentioned here, and higher leverage for BDCs. So they give more leverage, they give more debt, more debt. They prefer more debt because they realize that debt is cheaper than equity. However, this is a pointer that I've highlighted here, is that, however, in a rising interest environment, BDC may lose. See, I told you, interest rate going down, the private credit funds go up. But the other impact is interest rate going up, rates are rising, private credit, due to the floating rate nature, their overall growth will fall. That is something that we need to understand. And this rising environment can benefit a bank as compared to a private credit funds. So that's it. That's all that we need to know for this particular chapter. So, reading number 103, Global Financial Stability Report. So, this particular chapter talks about geopolitical risk and how these geopolitical risk affect the options premiums, the equity market, the country wise, how does it affect, on what sectors does it affect. So that is what this particular chapter is all about. So let's start, identify and explain the key channels via which geopolitical risk influences the asset prices and financial stability. So what is a geopolitical risk? It refers to disruptions from wars, terrorism, trade conflicts like tariffs, sanctions, that impact the overall financial market and growth. Okay, that is what geopolitical risk is. Even the threat of tensions can reduce asset prices, not even war or anything, just tensions between countries can reduce the asset prices. And of course, the capital will be shifted from one country to another just because of the tensions as well. Now, geopolitical risk affects asset prices via two channels. One is the economic channel, like there's trade is disrupted between two countries, the capital is flowing from one country to another country, production capacity is being hit, right? One is the economic channel, direct impact. right? That's the economic channel here. It leads to fall in the equities, bonds, commodity prices goes up, inflation in oil and everything, higher sovereignty debt, military spending, and lower revenues. Of course, the debt becomes more, you have to pay more so that people buy the debt. What are the other channel is the market sentiment. What does the market think? There's no major event. What does the market think? Uncertainty. It is driven by uncertainty, fear, and risk aversion. Even without actual conflict, it can lead to low valuations and higher volatility in the market. So that's a sentimental thing. What does people think about the particular event? So, what policy measures can be taken at a country level? Strengthen the regulation, maintain fiscal and monetary flexibility. That is what can be done to counter this geopolitical risk. At a financial institution level, maintain capital and liquidity buffers so that you have enough cash. Overall, the goal is to improve resilience to any of these geopolitical shock. Next learning objective, analyze how global geopolitical risk events affect countries, sectors, and asset classes. How does it affect? See, if there's a geopolitical risk across happening in the world, what is the impact across countries first? The impact that has been observed is uneven. Some countries will benefit, some countries will not benefit. Okay. So if the conflicted countries, what's going to happen in, if two countries are fighting, what's going to happen in both those countries? They experience the most severe damage, including physical destruction, sanctions, and trade is going to be disrupted. Who benefits? Commodity exporters. They benefit because their prices, like oil is a perfect example, right? Oil prices go up, the who is the country who's exporting oil to the world, they will make money. And who's importing, they suffer because their currency goes out and they have to purchase from a foreign currency, so their currency depreciates, and of course the cost is higher inflation and everything within the own country. Okay. So country wise the impact is uneven, some will benefit, some will not. If I talk about sector wise impact of a geopolitical event, there's going to be some gainers, some losers. Of course, the gainers will be the defense because every country would want to spend more on their defense capability. Energy sector, right? Commodity prices, they go up, oil, gold, and everything. So they make money out of this. Losers would be the banking industry, retail, and the utilities because demand falls and there's going to be tighter credit. People do not want to take loans, they don't want to take EMIs, right? They don't want that burden, financial burden. So these are the sectors which will not be benefiting. Impact across asset class. If I talk about asset class, yes, some assets like commodities, they appreciate, like oil, gold. Usually they go up because of supply issues and they're considered to be safe haven. Equities, however, their prices fall down. Obviously, people do not want to get stuck their money, right, on a particular share or something which is naturally falling. No one would want to invest. So equity prices generally decline. Standard events cause a 3% drop whenever there is a geopolitical event. 3% drop, that while severe shocks can trigger declines up to 9%. So this is the impact on the equity prices. Generally 3% it falls, but if there's a huge, you know, event, 9% can fall the equity markets. If I talk about the sovereign bonds, they are considered to be safe havens, especially US, Japan, and so on and so forth. And these bonds appreciate. their prices go up because their demand goes up, and we know that the bond and the bond and the yield, price and the yield, they have an inverse relation. So if the prices are up, the yields will be down. Okay, that's what it happens. How severe would be the impact of these geopolitical events? It depends on type and how long the event would go on. If there's a war, military conflict, the militaries are getting involved, this has the largest and long lasting impact. If there's only sanctions between countries, trade disputes are going on, this has a relatively smaller impact as compared to the like actual war. Okay, so this is the severity of the impact. Now, how does the market behaves, you know, in response to the geopolitical events, maybe domestic or global geopolitic geopolitical risk events? Stock markets usually react mildly, okay, but large or global shocks can amplify the impact. If there's a domestic geopolitical event, mild effect. Global or large, it can have huge impact. And the effect depends on two things: uncertainty plus how investor is risk averse. If investors do not want to invest money, the market will keep on falling. So the average impact that has been observed is approximately 0.3% returns fall after country specific shock. So usually 0.3% on that day. If there's a large regional shock, which is above 2 standard deviation, the shock is higher, there's a 7 times more loss than 0.3. So 0.3 multiplied by 7, that much is a loss. But if there's a global shock, 20 times larger impact than just 0.3 into 20. Around 9% will be the larger effect. And of course, with long persistence, it will stay for a long time. That's the general stock market response. Moving on to the volatility. Does it change the volatility, geopolitical events? Yes. Even the volatility index, they spike after shocks, which leads to more uncertainty and tail risk increases. Okay, that's the effect on volatility. Military conflicts have the strongest impact on equity markets, especially in emerging economies. If there's a military conflicts, strongest impact on equities. Effects spread globally through trade and financial with nearby or economically countries. Neighboring countries, it also affects, but the country where the military conflict is happening, they will experience the strongest impact or significant downfall in the equity. Now, there are two case studies that has been provided here. One is a Russia-Ukraine war in 2022. What do we know about this? The information is that the invasion led to broad market declines. Europe suffered the most, right, because of the strong economic ties, and they were dependent on the energy from Russia. Firms with direct exposure to these countries, Russia or Ukraine, they saw valuations drop by about 2.5% within just a week. However, the impact of this Russia Ukraine, it was dependent on sectors which benefited and some sectors did not. Sectors effect was different. Defense and energy, they declined initially, while similar firms in other countries gained due to expectation. They other countries started to build up more or spend more on their defense and the energies, right? Overall exposure to Russia has reduced since 2022. That's the case study. Just good to know information. Read through it. What happened with the US China tensions in from 2018 to 2024? There was a tariff announcement, and by the US that caused significant equity declines, especially in China markets, where markets fell about 4% on average and nearly 8% after the 2019 US tariff. So basically the point is that when there's this US China trade tension in from 2018 to 2024, Chinese market fell comparatively more than the US market. That's all that you need to know. US markets were less affected, average decline of 1.3 and about this following China's retaliations. That's it. You just know the basics, you'd be good to go. Evaluate the effect of geopolitical shocks on sovereign. Now, how does the sovereign risk premium is being affected? See, sovereign risk premiums, they tend to rise following major geopolitical shock, right? Because see, will you invest in a country that is involved in a war? Maybe you can. But of course you will say that okay, I want more risk premium. I want a premium for accepting this risk. So the risk premium actually goes up for that specific country. So the sovereign risk premiums, they tend to rise following any major geopolitical event. Sovereign risk premiums are commonly assessed using CDS. And how do you measure it? Credit default swap spread. You look at the spread of the credit default swap. Of course, this CDS tells you about the riskiness. So these spreads tend to rise sharply after military conflicts. If there's a military conflict, because investors become more concerned about fiscal sustainability and debt sustainability, whether this country will pay me back. So, of course, the risk premium shoots up a lot. And of course, the spread also widens. If you know, the CDS is nothing but risk free bond minus the risky. So the riskiness goes up and hence the spread widens. That's a bad thing. So emerging markets are more vulnerable due to weak fundamentals, and the vulnerability also depends. The yields rise as investors demand higher premiums. So usually if two countries A and B are into a war, for these sovereign, the risk premiums will go up for both the countries, and hence the bond prices falls down because they will have to give more yields. You will have to give me more returns, only then I will invest in this particular country, sovereign bonds. So what happens when the yield goes up, the prices falls down. On the other side, the safe havens like US, Japan, Germany countries, the yields fall due to flight to quality. People keep on buying these safe instruments. Demand is high, price goes up, yields fall. That's the effect. What are the major risk drivers that if you want to understand the sovereign default risk? Higher debt as compared to GDP. If the debt is very high of the country, that's a red flag. Low foreign reserves, again, that is a red flag if that particular country does not have enough foreign reserves. And weak institutional quality. These are the reasons why that the sovereign risk premiums go high. The next thing is how investors price geopolitical risk in equity and the options market. See, ideally, what happens is that the market risk premium. So, I hope that you all know the CAPM, the capital asset pricing model. So, usually, investors price geopolitical risk in both equity and options market through risk premiums. Everything is risk premium, right? If I'm investing in stock market, I need a premium, more returns to accept that risk. If I invest in a particular share market, if there's a geopolitical risk, so basically what happens is both the see assets that lose value when geopolitical risk arise require positive risk premium, and that makes sense. This absolutely make sense. If there's a bond given by a country A, If their value is losing, what do you expect? Will you buy it? Maybe yes, but you will require risk premium to be more and more. Basically, positive risk premium would be required. Similarly, if there's a country B who does not have any war, if it is safe, everything is safe, and they're gaining value, maybe oil exporting country. So you will buy it any which ways, even though the risk premium will be less or negative. While assets that tend to gain value during periods of this geopolitical strength often exhibit negative premiums. Okay, so that's the concept of a premium wise. Now, what is the effect of geopolitical risk on the equity markets? On the equity markets, just like a CAPM has beta on the market risk premium, similarly, in case of the equity markets, there is a geopolitical risk betas. Okay, so there's a risk of geopolitical risk beta. So the beta is now geopolitical risk, and here it is market beta. So essentially, what happens is that in the equity markets and geopolitical beta measures a stock sensitivity to geopolitical shock. It can be positive if the companies are gaining energy, defense sectors. For that, it's going to be a positive beta, right? That's what negative beta will be for consumer oriented sectors. They will have a negative beta. So the returns were overall. So if you calculate the overall returns for a positive beta, which is for an oil, obviously you'll get more returns when you calculate it. But when you calculate the same thing with a negative beta for maybe an oil, sorry, consumer industry or something, obviously when you calculate this, your returns will be lesser because of the negative beta. After the invasion of Ukraine, the energy sector's premium. Now, this is a point, okay, this is just a good to know point, that after the invasion of Ukraine by Russia, energy sector's premium shifted from negative to positive because people perceived it to be a critical hedge. Ideally, before this particular thing, energy sector had negative beta. But after the crisis, people thought that, okay, we need to have oil. We need to have hedge because oil is used for hedging purposes, right? Airline company may use it for hedging. Everyone will use it. So their beta turned from negative to positive beta. That's what the point here is. So it can shift. That's the core takeaway. What about the options market? What about the options market, the geopolitical risk? Well, pricing geopolitical risk in options market, usually the premium specifically for the put options, it goes down because just think about it. Why do you buy a put option? Because if you have a portfolio, you want the portfolio, obviously you want it to go up, right? But if there's a negative event or a geopolitical risk, your portfolio will fall. And which options provide you the protection when the market falls? Will it helps you to make money? The only option is put option. So the put option premiums, which allows you to have the downside protection, the premiums go up. Even deep out of the money premiums, deep out of the money put option premium, that also rises very sharply. Okay, that's what the thing is, and we call this as a tail risk, which is deep out of the money put options. They also go up very, very sharply. That's the core takeaway of geopolitical risk in the options market. Finally, the last learning objective, describe the implications of geopolitical risk for resilience of banks and so effect on banks, non-bank financial institutions of a geopolitical risk. See, geopolitical shock increase market credit liquidity risk already. there's already, then they have to face this geopolitical risk as well. There's going to be sell off that reduces asset and collateral value. Obviously, if there's a geopolitical event, assets will fall down, collateral values will fall down, and that leads to tight lending conditions. Capital will be taken out from that country. There's going to be sanctions, they amplify even more stress. Cyber risk also increase. Okay, so banks and funds have reduced direct exposure to Russia Ukraine post these events. That's all that you need to know. Effect on the bank and non-banking financial institutions. Values fall down, they face market risk, credit risk, liquidity risk, so on, and cyber risk, so on and so forth. Effect on equity valuations now and the lending component. Obviously, when there's a war or a geopolitical event, this weakens borrower credit worthiness, leading to sharp declines in cross border transactions, low asset valuations, bank equity levels fall down, difficulty in refinancing foreign debt during heightened security. So basically, there's a concept of a rollover risk. Rollover risk means that if you've purchased that particular transaction, you want to roll it over for next maturity, you'll not find the right price at for this new contract that you want to roll over. Okay, so refinancing is also becomes a problem. Effect on investment fund flows now. See, those with higher exposure to conflict regions, with the exposure is towards the countries which are fighting, they face redemptions, low returns, and valuations pressure. They try to redeem their investments, with stronger impacts observed during major conflicts like this. Overall, geopolitical shock can threaten financial stability, right? Strengthening resilience requires better risk management, diversification, and strong frameworks by regulation. Overall, this is just a good read, not a huge chapter. Give it a good read, and you'd be good to go with this particular chapter. Monetary and fiscal policies, safeguarding stability and trust. Now, this is a very important chapter because it talks about a lot of policies, quite abstract here at beginning. So you have to understand things at a very high level. Okay, you do not have to get deep dive into this particular reading. Okay, and on the basis of this, you'll realize what exactly is monetary and fiscal policy, which will be useful in chapter number 100 or reading number 100, right? Which is laying a robust macro-financial framework. So let's first try to understand what exactly is a monetary policy and a fiscal policy. Monetary policy, if you look here, it is managed by central banks. So I'll just give you a very quick example here. So let's suppose that the goal of the central bank is to reduce the inflation in the market, right? So there's a lot of price increases, and the central banks want to reduce that. So what they can do is that they will influence the economy indirectly via the interest rates and money supply. So let's take both these examples, interest rates as well as the money supply here. So if you look at the interest rates, what they'll do is they will make the interest rates go higher. So they will increase the interest rates. When the interest rates are high, what happens? All the loans, they also, it becomes costly. Borrowing cost it actually goes up. So the loans and everything becomes, it goes up. And hence, people borrowing, they do not borrow much loans. They do not take loans much. And hence, people do not have money to spend. So the consumer spending drops. Demand, that is why, of the product and services falls down. And hence, people reduce the prices. And that was the overall objective. So finally, the inflation also drops. So you see, this is how using the interest rate as a tool, indirectly, the government has, or the central bank has reduced the inflation here. Similarly, if you look at the other thing that we have, that is the open market operations, what it does is that the central bank, they buys the bond from the general
public, and hence they get the money from people who purchases these bonds. So indirectly, the central bank is pulling out the money from the general public or the system, and hence they reduce this money supply. Whenever the money supply is reduced, right, money has been taken out from people, money supply reduces, the demand falls down. Just as good as consumer spending falls down, demand falls down, price falls down, inflation drops. So that's the essential tool that we have using the monetary policy. So what are the tools that is used? Open market operations, policy interest rate, as I just explained here. And what are the impacts? Well, they it can have an impact on the bond yield. We know that the interest rate does have an impact on the bond prices. Borrowing becomes costly, asset prices may go up and down. Exchange rates also is affected by monetary policy. Now, the other thing that we have here is the fiscal policy, and this is managed by governments. Okay, and it is a direct management by government. So as an example here, so you can have a tools like taxation, public spending, subsidies, all this thing that we have it here. So I'll talk about two examples. The first is the government spending, and the second one is the taxes. So let's look at the fiscal policy. So what essentially government does, if the goal is to reduce the inflation, they will cut down on government spending, and hence the infrastructure subsidies, if less money. And of course, if you have less money, the inflation drops. So this is one of the things that is done via the government spending. So they basically taking out, they are spending less, and hence money supply is less in the market. That is why you see less of the inflation. But when it comes to taxes, they increase the tax revenue or the tax base. Then what happens? Less money will be with the people, and hence there's going to be less consumer spending, less demand, less price, and effectively inflation drops. So this is the overall thing that we have when it comes to monetary versus the fiscal policy. I hope this gives you a brief idea about this particular thing that we have. Okay, now what is the interaction between monetary and fiscal policy? High fiscal spending, that means a lot of the government is spending very much higher on infrastructure, subsidies, everything. That automatically increases the demand. When demand goes up, prices goes up, and hence indirectly the inflation also goes up. So when the inflation goes up, what's going to happen? Obviously, the if you look at it, when inflation goes up, the central bank will come into play, and they say that okay, now we need to increase the interest rates to reduce that high inflation, right? So that's what essentially happens. So that's the interaction between the fiscal and the monetary policy. So high fiscal spending, inflation goes up, then obviously monetary policy kicks in, and there's going to be a rate hike. As against a tight monetary policy means a higher interest rates already. If the interest rates is very high, it becomes costly for the government to borrow the money. Obviously, as I explained here, if you look at this particular thing, if the interest rates are higher, right, the loans costly, it becomes borrowing cost becomes higher. So that against the it's a pressure on the government in terms of their fiscal policy. That's what the point is. So this creates a policy feedback loop. It's hit here and then it's hit here as well. It's a loop that goes on where fiscal expansion gives rise to monetary tightening, and monetary tightening, that means increase in the interest rate, pressures the fiscal budgets. This is all that you need to know. I think this is the basics. Okay, there's a concept of a region of stability. What do you mean by region of stability? If you look at this particular Venn diagram here, so here we have the monetary policy, here we have the fiscal policy, and the joint probability where both the monetary and fiscal policy is connected, this is what we call as a region of stability. That means here what's going to happen is there's going to be stable economy, right? It's a balanced zone where both policies support stable, healthy growth. There's a growth factor here both in the short term as well as the long term. So that's this joint probability here is what we refer it to as a region of stability, right? Now, the region of stability is country specific, it is hard to define, and constantly it shifts. Sometimes this region of stability may become shorter, okay, and sometimes it may become larger as well. So the greater the better, but if it is very small, then there's less margin of improvements. So you don't want a situation where the region of stability is very small, otherwise there's not going to be stability in the growth in the economy, right? There's going to be a lot of challenges. That's what the region of stability denotes. It is influenced by gradual changes like demographics and sudden shocks like geopolitical events. That is also, it influences that. Policies like regulation or foreign exchange intervention can alter its boundary. So whatever the central bank, when it what does in what they do in their monetary policy, and the government what they do in terms of fiscal policy, that has an effect on the region of stability, right? But this is the broad idea I think that you can actually take. Okay, moving on to the next learning objective, which is describe the consequences of breaching the boundaries of the region of stability. So, what essentially happened and how the consequences have evolved over time. So, we're going to be talking about two or three phases here. Phase number one, it essentially talks about from 1960 till the mid 90s. So there's 20 years of duration that we almost have it here. And in that phase during 1960, there were some policy that overreach led to high inflation and debt. So the government and the central banks took certain fiscal policy measures as well as the monetary measures, which essentially they tried to fine tune the growth in the economy. So that was the phase all about. They wanted to have better growth and better prospect, but managing this aggressively, okay, that caused inflation during this 20-year period. And of course, there was an inflation, and hence there was a price instability at that point in time. So this was the phase wherein it led, usage of monetary and fiscal policy together that led to inflation, and hence it led to price instability. Talking about the next phase, which starts from mid 1980 to 2020, this focus moved from inflation to financial imbalances with crisis driven by excess credit and rising debt. Now, here in this particular phase, what essentially happened was after the mid 1980s, there was globalization, right? There was essentially financial liberalization. So, a lot of countries they started to invest in each other and all these things. And hence, there was the drop in the inflation. Okay, rates were absolutely low to boost this globalization demand and everything. But due to low rates, what happened is that a lot of people started to borrow. Imagine you go to a bank without, they're not charging you any interest rate or very less rates. Obviously, people will borrow, right? And what happens? The debt went high. And due to this huge pile of debt, the excess credit that we are talking about, there was a financial instability that we witnessed in 2008, right? Lower interest rate time period. So this was a phase number two, 1980s to 2020. And after that, we had post COVID time period where stimulus caused a rapid recovery. So there was a lot of stimulus, given by the government that increased the money supply, right? And whenever money supply goes up, what happens? Inflation goes up. The debt also went up because there was a stimulus, and of course, the money supply, the bonds, people started, government started issues bonds and everything, and hence the overall thing. Now, this is a twofold thing: inflation went up, debt went up. So there was entirely vulnerability in the financial system. So this is what essentially happened. If you breach the boundaries of the region of stability, it can lead to either price instability, financial instability, and even the financial vulnerability, right? The entire systemic risk. Now, there are a few factors that actually contributed to the trajectory of monetary and fiscal stimulus. So, what are those few factors? First, when sovereign debt levels are high, when the debt is already high, fiscal stimulus has less stimulative effect. Because obviously, what happens is that if the interest rate is already higher, and let's say the inflation is high, they want to reduce the inflation, what will the central bank do? They will again raise the interest rates. But if it is already higher, it's not going to have much huge impact. That is why we saw price instability, financial instability. There needs to be a good effect. Otherwise, it's like a diminishing, marginal returns, or kind of like a diminishing uh, effect that we actually see in terms of interest rate hikes. And more extreme monetary efforts are needed to have an impact. So a certain amount of interest rate will not do. There needs to be a huge interest rates that needs to go up in order to control this inflation. Second, there is a self reinforcing interaction between fiscal and monetary. As I said, you work on the fiscal policy, monetary takes a hit. You work on the monetary policy, fiscal deficit or debt actually goes up. So, somewhere or the other, that needs to be managed, a balanced approach. That's what we actually see here. So, that's the core idea that you need to just take away. Now, what are the implications of this foreign exchange rate dependency? Now, there's also a foreign exchange rate that affects the advanced economy as well as more to the emerging market economies. But what is the implication? The region of stability is smaller for EMEs as compared to the advanced economy. This is one thing that you need to remember. Okay, so if you look at the region of stability for the emerging markets due to the exchange rate, it's quite smaller. That's what the takeaway is. Boundary breaches amplify currency depreciation. So if the region of stability is like this, then that means a very small margin of improvements is there for emerging market economies, and hence there's going to be currency depreciation. People will not, or there's going to be, investors will take out the money. That's what the point is. Monetary policy in advanced economy can have a ripple effect in EME. Now, if there's any monetary policy in advanced economy, so let's say the advanced economy, their monetary policy, they are hiking the interest rate. Let's suppose that this hike in the advanced economy can also have an effect on emerging market economies. One country is situated here, the other country is situated in other part of the world, but still this, because of this low or this small region of stability, it can have an impact on their currencies as well. EMEs are shifting to flexible exchange rate regimes. They are moving towards the flexible. Just remember this thing out. Okay, the next learning objective, it talks about the risks that global economies face as a result of high public debt level. So straight up, you can see that what are the risks from high public debt and policy tensions? High public debt poses serious challenge to both monetary and fiscal policy. If the debt is already high, it limits flexibility, increases financial vulnerability, that's phase three, and cause tensions between inflation control and economic growth. So there's going to be a tension between these two things. Now, this debt strains government finances, complicates the fight against inflation, and introduces substantial financial stability risk. Because obviously, if there's already debt is already high, and let's suppose that inflation is already high, the very natural choice to control the inflation is to play with the interest rates, right? To increase the interest rates. But if you do increase the interest rate, this cost of debt for new borrowings also increases for the government. So this is kind of a situation that needs to be balanced out. Okay, so that's the risk from high public debt. But apart from that, there are four things that happens here. Uh, Intersection of multiple fiscal and economic factors. Okay, now including the potential for these high debt levels in combination with other factors to drive tension between the fiscal and monetary policy. So let's look at the other factors that drive the tension between fiscal and monetary policy. The very first thing is obviously the intersection of multiple fiscal and economic factors. Okay, fiscal and other economic factors. So let's say government debt, spending, inflation, interest rates, they are all closely linked to each other. Inflation has temporarily boosted tax revenue. So obviously, if inflation is high, that means prices are higher. You're paying higher prices. Obviously, the revenue or the taxes, or let's say prices are higher, we can say that wages might also be higher. So you're earning high, there comes the tax. You're paying for the prices, there comes the tax. So the revenue of the government actually goes up. So the government feels that okay, their fiscal budget is, it's going well. So their fiscal positions look healthier than they actually are. But in reality, it is not what it is actually seen. Why? Because if there's a high inflation, there's going to be some consequences. If inflation stays high, central banks must keep interest rate elevated. They have to keep the interest rate elevated, which raises borrowing cost. Okay, so obviously then the debt or the borrowing cost for the government or the general public, that takes a hit, right? Now this is the just the interaction that you need to actually know for this particular learning objective or this particular intersection of multiple fiscal and economic factors. This is something that just give it a good read. Okay, what are the consequences of high inflation? If inflation is high, central bank must keep interest rate elevated, which raises borrowing cost. Now, there are two things that can actually happen. Central bank bond buying post GFC shortened the debt maturity. Now, if you look at the entire article by BIS on this, there's an entire paragraphs or an entire page of reading that just talks about how the debt maturity was shortened. But for this particular reading, I would say that just remember this thing out. Do not need to uh, get too much into detail. So what essentially, I'll just give you a brief idea. What happened was that the central bank, they started to buy the bonds after the 2008 crisis. They started to buy those bonds post GFC. Now that essentially this movement actually led to debt maturity started to fall down. So they shortened the debt maturity. But this cut the short term cost of the bank, but lowered the remittance to them. But they did not get those remittance. Just remember this thing out. High fiscal debt increases annual debt servicing cost as well. And of course, if there's already a high debt, that also means that you have to pay higher interest, right? Which is expected to reach 6% of the GDP. That's the consequences of high inflation. Just remember this thing out. I think it's going to be good to go. Just this is all that you just need to know. But even if there is a high fiscal spending or debt, why can't you just cut it down? Why can't you reduce it? Why? Because of inflation. Inflation is high. We need to keep, the government needs to keep supporting the people, right? The aging population, they need the social welfare and all the other things. There are some global challenges which push the government spending on the higher side. And hence, it is not possible for the government to actually cut down on their spending as well. This is the reason why cutting fiscal spending is difficult. Okay, now there are certain counter cyclical effects as well. What do I mean by counter cyclical? As I said, if you work on the fiscal policy, your monetary policy takes a hit. If you work on the monetary policy, it doesn't provide much or rather we can say that it doesn't, it hits the fiscal policy policies as well. So as an example, the fiscal policy, if let's say there's a deficit, that means the government spending is $100 and they're earning in terms of taxes, let's say $70. So 30, that means the 30 is something that is the deficit that government needs to borrow. So if they borrow, obviously their debt increases, debt goes up, money supply goes up, money supply goes up, inflation goes up. And when what happens when the inflation goes up? Central bank kicks in with the monetary policy tightening or raising the interest rates, right? So this is the counter cyclical behavior between fiscal and monetary policy. Now, monetary and fiscal policies can work against each other. Large fiscal deficits stimulate demand but raise inflation, which leads to higher interest rates in return. These higher rates can turn economic weak, undermining the fiscal efforts which was initially taken. So this tension is especially visible in emerging market economies where even weak exchange rates can worsen the inflation impact. So this is what the counter cyclical effects are. Now, high debt levels can also prevent monetary policy officials from taking their desired actions. The central bank will not be able to take their desired actions. So we term this as a fiscal dominance. So there's a lot of fiscal stimulus or dominance exist when monetary policy is constrained due to fiscally imposed constraints. The government does not want, let's say, the interest rate to go up. So in that situation, we call this as a fiscal dominance, and you cannot just play with the monetary policy or the interest rate tightening. That is just one other thing. And this situation can arise due to the following reason. Because understand, even the governments have pressure, political spending pressure. There's often pressure to maintain or increase spending in support of fiscal priorities, to give subsidies, to have better infrastructure. So that's why the government has to do it. There's no reason why fiscal dominance exists, because of the pressure for the government to perform. That's one thing. Sovereign debt implications, and the debt which is given by the government, they have to keep paying the interest on that. Interest rate increases could spark a sovereign debt crisis under circumstances. Imagine a government has given a bond, and if interest rates keep on rising, obviously their prices are falling down, right? So even the sovereign government bonds, it has an effect. If interest rate goes up, their bond prices will fall down in value. So it can lead to a sovereign debt implications. That is why there's a fiscal dominance, and it doesn't allow much flexibility for monetary policy actions. That's the thing. Okay, moving on to the next thing, and that is the financial stability risk. Now, the entire financial stability. So understand, sovereign debt is vital for financial stability. We know that, right? You can use the sovereign debt or a bond as a store of value, like a treasury bills. It can work as a collateral and even as a benchmark, as a risk-free rate for pricing the other assets. Sovereign credit crisis, like a downgrade or default on a particular government bonds, can disrupt the pricing of risk across the economy. So we need to have that financial stability together, right? We need to have that. And government acts as a backstops. What do you mean by backstop? As a last resort. We have seen in the case of SVB Bank, we have seen in the case of the Credit Suisse, the government steps in, right? So they are acting as a backstop, as a last resort, with central banks serving as lenders of the last resort. So this creates a feedback loop. Again, it takes a feedback loop. Banks rely on these bonds, sovereigns, and sovereigns rely on bank stability. So it matters, because if sovereign bonds fall down, they'll not be able to help out the banks. So that's why that's very much needed. High debt raises the risk of sharp bond yield movements, especially during monetary tightening. In panic phases, investors may flee sovereign debt for cash, causing liquidity stress. So that's why it's important that we need to maintain that sovereign debt. Loose fiscal and monetary policy increases fragility. It makes, if market sense a breach in the region of stability, if they feel that the region of stability will just shrink, bond repricing can trigger systemic risk. And hence it's important to maintain that region of stability. Then finally, we have the policy implications. Monetary policy should focus on price stability, while fiscal policy must remain conservative to preserve flexibility. So this is what the entire policies should actually look like. Okay, monetary policy, price stability; fiscal policy to preserve crisis and avoid fueling inflation. That's the ideal motto. Central banks should reduce the balance sheet gradually to retain future policy space. So that's how they should go. Uh, not like abruptly they should change their balance sheet or the interest rates. Fiscal spending should prioritize long-term growth like infrastructure, not short-term transfers. Central bank independence is crucial to avoid any political interference. So the central bank should have that flexibility to change the interest rates as and when that actually is needed. Okay, so this is what the entire chapter is all about. Give it a good read and you'd be good to go. All right, let's move to reading 103, which is the regulating the crypto ecosystem, the case of unbacked crypto assets. Now, let's look at the first learning objective. Define and describe the crypto assets, including the categories broadly used by global financial regulators to classify them. So, let's look at certain definitions or basics here. What is an unbacked crypto asset? So, it's a decentralized or sometimes centrally issued. They are mainly used for speculation, which is not backed by any specific asset. For example, if I say that a commodity contract is maybe backed by certain commodity, but here when it comes to a crypto asset specifically unbacked, it is not backed by any financial asset. So you can have, like example is a Bitcoin or an Ether. Now this are mainly used for speculation purposes. What are utility tokens? It is like a gaming token. You buy a specific token to play a game or to enter into that gaming zone, right? That's a utility token. It allows access to a specific product or service within a single or closed network. Security tokens, it is as good as a digital security that you buy, just like how you buy a bond or an equity share. It represents rights similar to traditional securities like profit sharing or ownership, and definition can vary by jurisdiction. Stable coins, it is aimed to maintain price stability by being pegged to assets like fiat gold or other crypto. So example, Tether, USDC. So here this is a coin, a stable coin which is backed, or it has the effect of USD currency going up and down. As USD goes up, their value also goes up. As USD prices goes down, their overall value will also fall. So that's the stable coin. It is pegged to a certain currency or a gold or any kind of an asset. Okay, what are crypto assets? Crypto assets are digital assets that use cryptography and distributed ledger technology like blockchain to securely record transactions. So let me just explain you in just a brief as to what blockchain is. So what happens is that if you have, let's say, Bitcoin and you want to transfer from here to, let's say, another network or another to another people, let's say that, in that situation what happens is that this is the front end, like you just take your phone and you just transfer it. But what happens in the back end is there are like validators or miners who will actually, miners, they will actually validate the information, and they mine this particular thing, and that allows in the back end to transfer from this to this, let's suppose that. And then here, let's say from this it moves to another person or another location. So the same details what I mentioned here, it's going to be transferred here, and then new information can be added here as well, like the amount, quantity, so on and so forth. So this kind of a technology, and again the validators, miners, they do the back end task and the processing. So Essentially, what happens is that this is known as a distributed ledger technology, DLT, distributed ledger technology, wherein, let's say, you're transferring from one person to the second person to the third person. So all this information gets stored in each of the chain, right? So it passes on from here, it passes on from here, like that. So this is just a very simplified example, but I hope that you get the context here. So crypto assets, consider Bitcoin, they are digital assets that use cryptography. The validators and miners use that, and DLT technology like blockchain to securely record transactions. So what, why did you pay the Bitcoin, for which purposes, let's say that. So blockchain, which is the most common distributed ledger technology, stores immutable transaction records in linked blocks. So it stores, everything is stored in these blocks, whatever that you mentioned. Now, crypto assets can be backed or unbacked. So stablecoin is example of a backed asset. Unbacked is a Bitcoin. Unbacked assets like Bitcoin have no intrinsic value, rely on supply and demand, and are highly volatile. If the supply demand, it's a function of that. Mainly used for speculation rather than as a true money. Okay, now I've got this here. Just read it out. I think it's going to be good to go. So there's like an NFT tokens. It is usually centrally issued right to ownership of specific product, collective and non-substitutable. Just know that it's centrally issued, and there's a right of ownership when it comes to NFT tokens. Okay, it's like a tokens. Uh, Security token, it is centrally issued, again meets the definition of security in each respective jurisdiction and within the regulatory perimeter. Utility tokens, for any utility, centrally issued right to product service except across multiple ecosystems. Just good to know. Unbacked, like the Bitcoins, usually decentralized. This is only difference here. This is centralized, centralized, centralized. This is decentralized, designed to be used as a means of exchange. Limited rights for the token holder, no single issuer to enforce rights, transferable as well. And when it comes to stable coins, it is designed to be value stable. It is pegged to certain assets, like that. Just remember that. CBDC is a central bank digital currency. It is central bank, as the name suggests, so it's obviously centrally issued by a state or a central bank, designed to be value stable. Stability mechanism is usually sovereign fiat currency. Just read it out, okay? You don't have to remember it, just read it out. You'd be good to go with this. Okay, describe the key components within the crypto ecosystem. Now, obviously, there are many components, but we're gonna be deciding those components as per the people who are associated, the networks and everything, right? So first off, obviously, the issuer, the people who are issuing, let's say the Bitcoin in our scenario. So the people who are issuing, they are known as issuers. Usually they are decentralized, and they offer, unbacked crypto offer access and anonymity, but are hard to regulate. I don't know who is the issuer, who has given that. It's purely anonymous, so there's really hard to trace that or to regulate that. Hence disclosures are limited. Network face risk like cyber attacks. This is a major risk when it comes to the crypto ecosystem, okay, in terms of issuers. Now the issuers can issue, let's say, any coin or a Bitcoin via pre-mining, ICO, just like IPO, like initial public offering. Here it is called as initial coin offering. Okay, but it can also lead to fraud and manipulation, because there's limited access. Anonymity is very less. Really high chances for cyber attacks and so on and so forth, right? There's a concept of a white paper that often exaggerate benefit. What is a white paper? White paper is like a policy document. Just when you purchase any policy, similarly, the issuers, they issue the white papers. Marketing materials, including white papers, often exaggerate benefits and hide the risk. Okay, so what are the regulatory response? See, what does the learning objective talks about? What are the key components within this? The potential risk that they can have, and the potential regulatory responses to address those risks. That is what the learning objective is. So what are the regulatory response? What does the regulator wants? Well, when you publish a white paper, that marketing brochure, okay, emphasize clear, accurate, and understandable language with essential details about the asset and its risk. That's very, very important. Notification process, suggesting a mechanism for regulators to be informed about white paper availability to monitor developments and risks. So continue notify the consumers. Suitability, is it suitable for me? Is it suitable for you? Recommending assessments to determine if crypto assets are appropriate for retail investors. Let that be published in the white paper. Marketing, advocating for fair, accurate, and transparent marketing materials aligned with the white paper. So you can market as like, okay, it's good, it's going to give you solid returns, but that needs to be fair, accurate, like that. Consumer should be educated about the risk of investing in crypto assets. That's what the regulatory response is. Stressing the importance of financial and technology literacy programs about cryptocurrencies, so on and so forth. That's the regulatory response that we have. Now, what are the crypto asset exchanges? So that's first we spoke about the issuer, the risk that they can have when it comes to white paper, marketing, so on and so forth, and the regulatory response. Now let's look at the exchanges where cryptos are listed or you can buy it from. Exchanges facilitate buying and selling of crypto assets and may also act as custodians where you can keep your coins, or they can act as a market makers as a if you want to buy that, they can become a seller. If you want to sell it, they can become a buyer by trading from their own inventory. So that's what they essentially do. So crypto asset exchange, they provide direct retail access. If I want to buy it, I can go to that particular exchange. It enables individual trader to engage directly without intermediaries. Like for example, in if you want to buy into, let's say, derivatives, you may have to go to a CCP or a member of a CCP. They go to the CCP and then that goes to the exchange. Here it's a direct retail access. So there are no members, no CCP, nothing like that, right? You just go to it, you get it. They trade from their own inventory. As I said, they become the market makers themselves. So they trade from their own inventory. They provide custody service as well. They offer storage of your coins, the asset, crypto assets. You can store it with them. That's what they do. But what are the risks of crypto asset exchange? Well, first of all, there's a custody risk. If you store your, let's say, Bitcoin with a particular exchange, that particular wallet could be hacked. So there's a cyber credit or a counterparty risk. Operational and cyber threat, it could be hacked. There can be bankruptcy to the exchanges themselves and even the loss of the asset, right? There could be market manipulation, like of course we don't know their exchange style and all these things. So it is high in anonymous, and the market is also very illiquid. There is a proof of stake. POS stands for proof of stake. So as I said, the validators, the miners, they mine it, they get that particular transaction done by using proof of stake. But don't get into that, but just remember this: large exchange can dominate proof of stake network. What do you mean by proof of stake? If I just have to let you know in just a very short way, I would say that is that let's say if you have a large computer or a large system process, you'll be able to mine the coin effectively. Imagine the exchange, the amount of money that they have, the bandwidth that they have, that they can have a best of the best systems to mine the coins, right? So large exchanges can dominate this proof of stake networks, increasing centralization and potential conflicts of interest. So they'll do things which would be in their favor. That is what we have it here. Okay, changes in regulation for crypto asset exchanges. Crypto regulations differ across countries, with many lacking clear rules. Most focus on lower risk tokens, allowing exchange to avoid oversight by listing unbacked crypto assets. Regulatory gaps remain, especially for decentralized platforms, which are decentralized regulations. It's really hard to detect them, right? Okay, that's what we have for that. Now, the within this particular thing, we have another category, which is the wallets. Okay, so wallet is the third thing that, where do you store that? In a digital wallet. So digital wallet, it stores the private keys needed to access the crypto assets which are owned by users. Losing a wallet means losing the private key, and therefore your Bitcoin or the asset or anything. You can just think about that. That's the digital wallet. Now, there are two types of wallets. First one is a self custody. That means you keep it with yourself. So you have control over the private key. You bear full responsibility for security, but risking it for, but risking irreversible loss if the keys are lost. So I keep the key with me for that digital wallet, the private key. And if I lose it, I lose the asset. And then you can go to a custodial service like an exchange or something. Third party exchanges manage the private keys. This reduces my burden, but introduces risk like cyber attacks or mismanagement. Again, this is the type of wallets that we have. Classification of wallets. Now, there could be two types. Hot wallet is online for quick transactions, which is vulnerable to cyber attack. I can pay it via digital way. A cold wallet is offline for secure long term storage, susceptible to physical risk like damage to USB pen drive, but preferred by exchanges. So you can keep your private key in a pen drive. That's a cold wallet. And when you attach your pen drive, only then that private key is visible to you. So that's a cold wallet. Now, wallet security in crypto regulation. So, what are the regulatory priorities? Regulations aim to protect user assets through segregation, strong cybersecurity, accurate digital ledger technology based records, anti money compliance, anti money laundering compliance, prudential norms, cyber insurance, wind down plans. Just give it a good read. No need to get too much detailed into this particular thing. What the regulatory priorities? Just read it out. Okay, as I said, there are validators, miners, and the technology that they use. Validators, they validate it at the backend task. So, digital ledger technology improves security in the financial services through immutable transaction and audit trails. Private blockchains offer more control but suffer from fragmentation. Now, what do you mean by this? Is that you can have blockchains which can be divided into multiple things and it becomes really fragmented, right? There's a limited interoperability and centralization risk as well. Initially, when Bitcoin or all this crypto assets were launched, their theme was to have a decentralized approach. But if I have the best of the best computer systems, the best of the best validators, I'm the best of the best miner, obviously the power lies with me. So in effect, I'm controlling that. So that centralization risk, there is still there in a private blockchain. But as against to a public blockchain, they are resilient to single point failure. So if let's say a particular coin is hosted by a particular exchange or anything like that, if that public blockchain is cyber attacked or anything like that, then that's a single point failure, but faces risk from user behavior and governance issues. So there can be user behavior and governance issues. Just give it a good read for this thing. Don't get stuck in this a particular case for the validators, miners, and technology. Okay, moving on to moving on to the regulated financial institutions. Banks and financial firms face risk from direct exposure to volatile crypto assets and indirect links. So now, obviously, banks, let's suppose that the bank has lent me some money. Now, I take that money and I invest in crypto assets. So, banks' indirect exposure to the crypto assets is what we are talking about in the regulated financial institutions. So banks and financial firms, they face risk from direct exposure. Maybe they have bought it directly, or maybe indirect exposure, like lending, insurance. They have insured that particular crypto assets like that. So Basel, it proposes risk-based classification. The unbacked crypto would attract higher capital requirements. So if there's a bank in their balance sheet, if they have the unbacked crypto, Remember the risk weighted assets that you calculate, it is going to be higher for the unbacked crypto assets. So, what is the current regulatory focus? Current regulatory focus is on a conservative approach. Capital will be deducted uh, for using this unbacked crypto, stricter risk weights, and monitoring exposures. Okay, how do you need to monitor your exposure to this unbacked crypto? Institutions like asset managers, brokers, and insurers are increasingly offering crypto related products that increases systemic risk. Even the asset managers, brokers, insurance companies are increasing offering crypto related products. So you see, we need to regulate the financial institutions, not just banks, financial firms, as well as these asset managers, brokers, and insurers as well. Now, crypto asset provider functions and market infrastructure. In crypto markets, single entities handle multiple functions like custody, clearing. Think of an exchange. That raises risk. This concentration can lead to disruptions, unlike the segmented traditional markets. Regulators must identify systemic crypto players, large issuers, and treat them as financial. So FMI is the new word, financial market infrastructures. That is what we mean this by here. Okay, moving on to the next learning objective, which is the identify and describe some of the global approaches to the regulation of unbacked crypto assets, including the BCBS proposed treatment. Now, this is just the important thing here is this particular paragraph that we have it here. So remember this thing out, and the rest is just the details that you just need to go through it. Okay, what are the global approaches to regulation of the crypto markets? Regulating crypto assets on a national setting may be sufficient in the absence of harmonized global regulation. Domestic regulation can be too much or too broad or too less. Examples of different regulatory focus includes stable coins and tokens. Operational aspects in the Japan and Albania jurisdictions can be crypto friendly or restrictive in the case of Nigeria, right? Activities relating to crypto assets can bypass the domestic rules and regulation, especially where monitoring is difficult. As a result, stronger international cooperation amongst regulatory is needed to address systemic concerns. But this is just important here, as I said. Instead of broad banning on crypto assets, regulation should mainly focus on clarifying rules relating to the economic functions of crypto assets and technical design. So, what are the rules or things that we should do? The BCBS, it proposes to categorize banks' asset holdings as either low risk or high risk assets into two categories. Low risk would have a similar or a lower risk weighted assets, like a risk weight that we have in operational risk, than traditional assets. Obviously, they'll have lower risk weighted. While higher risk assets, let's say crypto in this case, would have significantly higher risk weights, which is 1250% risk weight for both short and long term. So if any bank has crypto exposure, let's assume that. And in that situation, 1250% risk weight capital should be reserved. That's what the proposal here is. This is just that is crucial here. Okay, examine the last learning objective. It talks about the consideration and steps introduced by the Bali FinTech agenda for developing a regulatory framework for crypto assets. Just read this particular thing. Okay, just read it out. Uh, it's really hard to remember all these things, but understand it. The Bali FinTech agenda is a global regulatory and supervisory framework for regulators that addresses fintech risk, including crypto and related technologies. So, what are the considerations for crypto asset regulation? Monitor any new development and technologies in the crypto space. Prioritize any resources, okay, which are allocated to jurisdiction. scope of regulation to determine which aspect of crypto activities should be regulated, which one should be regulated, which one should not be regulated. And then domestic collaboration and coordination between various regulatory authorities to address specific risk, continuous risk assessment to identify changing risk and provide strongest protection to markets and consumers. Just give it a good read. I would say that it's really kind of like a very abstract thing, but just give it a good read, and you would be go and you'd be good to go with this particular chapter. Okay, so read this particular book. That's going to be very much beneficial.
Reading 103, the digital resilience and financial stability, the quest for policy tools. Now, this is, but just give it a good read is all that I would say for this particular chapter. Describe characteristics of cyber risk and ICT risk. What is a cyber risk? It's a loss of confidentiality, integrity, and availability, or it's also known as CIA triad. Right? You need to have confidentiality, integrity, availability of data when it comes to data, right? This is what the thing is. So, a loss of CIA triad is referred to as cyber risk. Okay, confidentiality is compromised, integrity is compromised, and it's not available. It has been hacked. So that's the cyber attack. The examples is the breaches of client information, unauthorized access to a system, funds theft, and this the DOS attack. I'll have to check what is this DOS. Denial of service. Denial of service. So that is part of the DOS. Denial of service attack. Okay, something you have the system, but you're not able to access it. So that's denial of service. Importance of the cyber risk is that ranked as significant as market risk. Can you understand? As significant as market risk for a trading desk, we rank cyber risk in that same level. Challenge is that difficulty in estimating losses due to lack of reliable data. So that's a huge challenge. Hindered development of cyber insurance. And then there is also the development of cyber insurance is also very less, so that's the problem or the challenge with the cyber risk. When I talk about the ICT risk, it is the disruptions in information and communications system that may not stem from cyber attacks. So information and communication system has been hampered, not from cyber attack. That is what we can club it, or we can refer it to the ICT risk. System has been broken down, right? Communications failure, service outage. That's the example of ICT risk. It is essential for ensuring uninterrupted transaction services. As a bank, you need to make sure that your net banking, your internet banking is working fine. That's the main thing. So it's very important. The challenge is that the dependency on technology, you're very much, everything is dependency on technology here, and it's vulnerable to system failures. It can happen. So 106, and it is about tokenization and financial market inefficiencies. Okay, so this is a new reading for 2026. Okay, and okay, so let's begin with reading 106. This is a new reading. It talks about the mix of what we have seen in the last year as well. But again, it broadly it talks about tokenization. So it's important that we understand what exactly is a tokenization. We just spend a minute or two to understand the meaning of tokenization so that we can connect to it better. So let's consider this. Sorry. So let's consider this thing that if we have this particular building, right, and there are plenty of flats or apartments in a particular building. So what essentially we do is that if I want to purchase a flat here or an apartment here, I can go to the builder, I can pay the money, and I can purchase this particular unit. Fair enough. Now what I can do is this, all these units are pretty much expensive. Forget about owning an entire building. even these small apartments can be very expensive. So what we can do is we can convert these units or the entire building into multiple tokens, okay, or small parts, or we can say that multiple tokens. Now, these tokens, if I purchase this, essentially I have, ownership of that particular property. I may not live in it. I'm not living in it, nothing like that, right? But this is a digital ownership for this. Okay, so that is the meaning of tokens or tokenization. Tokenization essentially means that you convert a real asset into small parts so that everyone can own the particular asset. That is first thing. Secondly, how it is done is that it can be done via a smart contract. Now, what is a smart contract? You will see this term in the upcoming. It's gonna come, right? So what is a smart contract? It is nothing but a contract which will record each transaction in a particular blockchain. So for example, what happens is, let's say you and I, or let's say I've just purchased this particular token, so my name and everything will be, let's say, registered in this ledger or a book, right? It's going to be registered that, okay, I have purchased these many shares, these many tokens, like that. Fair. Now it contains all these things, and all the details will be encrypted in these blockchains. That is what the smart contracts are. So it's like a contract, but it's a smart contract. Just like we have a smartphone, similarly, we have a smart contracts which does these transactions digitally with better efficiency. Okay, and everything is recorded on a ledger or a book. Now, very important thing is that, will you be able to buy these tokens? You'll say that, okay, is it trustworthy? So the very first thing that you, as an investor, to purchase these tokens is automatically trust. Second thing is that, how will you buy it? That is known as programmability. Okay. So this is done by a smart contract. So how is it going to be programmed? It's going to be executed via smart contracts. And is it shareable? Can I just resell it, all this thing? Yes, that sharedness can also be done. So this is shared via certain models which we will talk about. But hopefully you have a fair idea as to what tokens are, which is nothing but a digital purchase of assets as a small portion. How do you do it? You need to have trust in this particular industry. It has to be programmed in such a way that the transactions can be executed. What about they pay interest on this? So let's say I purchased a bond. How a coupons will be delivered to me if I purchase token of this particular bond? Well, it's going to be executed by smart contracts. They will send it to you automatically, right? So all these things are something that, in a nutshell, is what we're going to be talking about in this particular chapter. Okay, so let's begin with this chapter. What is the process of tokenization? And describe the features of tokenized assets and digital ledgers, book, like that. Okay, so what are tokens? Tokens are digital representation of ownership which are recorded on a particular ledger. Think of them as a digital certificate. Just a minute here. Think of them as a digital certificate that proves who owns the asset and allow easy transfer between parties. It can be transferred, it can be shared among the parties, right? So that's what the point is. Tokenization is the process of converting assets into digital token. So we know what token is, nothing a small ownership, fractional ownership. And tokenization is a process of converting them, making them easier to transfer, automate, and manage. It is not a single technology, but a set of tools built on distributed ledger. Okay, so that is a tokenization. I'll show you the entire process how tokenization actually solves the current problem. We'll talk about that. So two types of tokens are there. One is a native token. Example is a Bitcoin, digital art, which is already existing. So these are already existing. So they are called as native. They are already existing part of the overall, they're already part of this particular ecosystem. But then a new thing has come up, which is known as a non-native. For example, we are taking the equity sector, we are converting that into tokens. We are taking real estate properties, we are converting that physical asset into tokens. We have bonds, we are converting them into tokens. So, what we are doing is essentially we are taking these products and we are converting them. That is known as non native tokens. Okay, now this is the diagram that I've just taken up here. So, tokenization, it is creation of assets on a digital ledger that is going to be shared among participants. It can be programmed, it can be trustable as well. Only then will investors purchase it. Okay, and how do you create that? That is known as a tokenization. A new issuance is known as a native, which is already existing ones. New virtual representation of an existing asset is a non-native, and it can also be a migration. For example, you have a native token, non-native tokens. Okay, fair enough. It can be migrated. That means existing asset, the existing token can be destructed and it can be moved into a new one. That is known as a migration from existing to a new one. That is a migration. Okay, what are the features of tokenized system? Now, broadly speaking, just think about it. You need these three things for tokenization to work properly, very, very properly. You need trust. Users should believe in secured and accurate tokens are provided. Very, very important. And if this trust is there, ownership is secure, transactions are accurate. So, trust is a very primary thing that needs to be there. The second one is the sharing capacity, sharedness. Ledger, that book that mentions all the records, is accessible and updates are directly recorded. Okay, that's very important. Accessible to all so that you can see already the ownership, right? And direct ownership updates. And the third one is programmability, which essentially means that the way this thing is programmed, that the transactions are done automatically. Specifically, the contracts are now are created, not a simple contract. We are creating smart contracts for automation purposes, right? So there's going to be automatic payments, conditional transfers, compliance, everything will be managed automatically. So these are the broad three features. Let's read through it. Tokenization functions only when the underlying ledger provides three essential features. There should be trust, there should be sharedness, all relevant parties can access the ledger, and it should be programmed. Okay, smart contracts can automate instructions and embed financial logic directly into the assets. Right? So this is the overall function of the tokenization and how can you can use it. Moving to the next learning objective, describe frictions and inefficiencies that can arise during phases of an asset's life cycle. I think let's understand what are the frictions, what are the challenges, what are the areas that needs improvements. And I think I have a diagram here. Yeah, here are the frictions that I've taken from that IMF report. So again, if you look at this frictions of a life cycle of an asset, first, what happens is the asset is issued, the very first thing you issue an asset. Let's suppose that how do you issue an equity security? Via IPO. Fair enough. But in the IPO, some people may have more advantage. Some people may have more information. So at the very beginning stage, some people have an advantage, right? So there is asymmetric information. That's a bad thing. There is such friction. We don't know what the actual price is, right? That can be a challenge. And there's going to be, of course, transaction cost in order to buy or sell this particular thing. So issue is the very first step. Okay, issuance of a security. After the issuance is done, the second stage is exchanging, buying, selling, trading is what we can call it. So search friction, of course, is it fairly priced? That's a thing. Transaction cost, you're buying, selling with another counterparty, there's going to be counterparty risk. The third thing is, of course, servicing. Servicing of what? Dividends. You're purchasing a share or maybe a bond, there's going to be coupons. Who will service that? Of course, there's going to be a transaction cost for these servicing as well. And the fourth and the final stage is the redemption. Basically, you sell the asset and the transaction is closed. So again, for selling or redeeming, you have to pay the transaction cost as well. So these are the frictions in the process of issuing, exchanging, servicing, and redeeming at the end. Okay. Now, how can tokenization help reducing that particular thing? So first thing we have already seen, right? Describe frictions, inefficiencies that can arise in the asset lifecycle. Now, how different features of tokenization can both increase and mitigate risk. It can help you reduce that, but because it is digital thing, there's going to be some risk as well. Okay, so we're going to be talking about that. Now, what are the market frictions? Market frictions are inefficiencies like issuance, trading, servicing. In all these transactions, what are the inefficiencies? Okay, there's going to be cost, delays, risk for the market participants. There's going to be the key frictions are information asymmetry. Example, in an IPO, one party has more information. There's going to be search frictions, difficulty finding buyers, sellers, prices, transaction cost, right? And counterparty risk. At each stage, you see that friction. Now, what are the role of intermediaries? Are they doing anything to reduce these frictions already in the market? Yes. There are some institutions like, for example, investment banks can help you find that, smooth out that IPO transactions. They can perform due diligence, underwriting, and everything. So these activities reduce these frictions, but it's not for free. It add cost to it. There's CCPs, that reduces that counterparty risk, absorb default risk. But again, this is also, they charge their admin fees. So, the clearing houses, they manage settlement, reduce the counterparty risk as well. So there are intermediaries in between, but they charge. Now, if you transact in the financial market, that also give rise to externalities, internalities, and market power issues. Now, broadly, we have to understand that what is an externality, what is an internalities, and the market power. Externalities are something that has to do, like, for example, I'll give you a very simple example, uh, a byproduct or a side effect. So, for example, if you think that fitness is a lifestyle, you're doing fitness, you're going to gymming, swimming, and everything as a lifestyle, automatically your body will come into shape. That's a byproduct of being fit, right? Similarly, when you do whatever, let's say we are talking about tokenization, there's going to be some side effect of it. There's going to be some uh, byproduct that automatically pops up. That is what externalities are. Now, when we talk about the tokenization, right, there's going to be certain externalities, like, for example, the positives and the negative. This is the overall broad definition. We are not taking into consideration tokenization externalities, we'll talk about that. Internalities, we'll again talk about that. And market power, which is there. But broadly speaking, what do we mean by all these things? Externalities can be positive benefit, as I said, if you pursue fitness as the activities as being fit, automatically your body will come in shape. So that's a positive externality. Negative can also be there. So what are positive in this financial market context? You can have a network effect. This leads to more participants. You naturally, if there are let's say CCP exchanges and everyone, and if you're trading a lot, people will see you, they will also pursue that, they will also pursue that. So it's like a feedback loop, it's like a loop that goes on. So that's a positive network effect. Negative is that of a moral hazard. Like for example, people think that okay, there's going to be a bailout, so they take more loans, they take more insurance, bad policies and everything, just to increase their business, right? So these can be negative externalities as well. There can be internalities as well. Okay, to understand this, we just have to link it towards retail investors, right? Retail investors. So basically, internalities are something which are poor decisions by investors. Okay, and for example, they are trading without understanding the risk. They do not want to go to a professional just to save money, right? So essentially, what is happening is that there's an internality effect. That means they take the trades and everything, but internally that is hurting them. That is what internalities are. And then, of course, market power. This essentially means that a dominant player, they will charge higher fees and everything, and that is what a market power is. Okay, so we do not have any choice. If a firm is charging higher fees, we may have to pay that if there are no options. So these are the, if you transact in financial markets, externalities can happen, internalities can happen, and market power does exist. Now, how do you mitigate these frictions through tokenization? Now, let's welcome tokenization. So, we spoke about the life cycle, right? The asset life cycle. Let's understand how tokenization can help. Well, traditional, if you want to issue that, it relies on intermediaries like investment bank, there's registrars, banks, trust companies for record keeping and transactions. Of course, they do not do it for free. There's a cost and complexity as well. Tokenization directly link the owner on a shared ledger. I purchase it, my name directly goes into it. No middleman. So, see, the issuance stage, I do not have to worry about who's having more information. There is no search friction, less costly as compared to these intermediaries. So, that is what this problem, the asset issuance, is taken care of by tokenization. There is smart contracts, they automate process like share auctions, saving time and uh, resources. So when you have servicing issue, it can be solved via smart contracts. Key data can also be embedded within the token. So whatever the important information, it is already embedded in the token. So that is one way that tokenization can help. The second way is that of trading thing. Now, usually what happens is that if you wish to exit from a share, typically it takes today, like for example, if I sell IBM share, the money will come from that selling of the shares. It's going to be taking today plus 2 days. So I'll have to wait 2 more days to get my money back, right? Typically, this is the settlement process. So traditional trading involves counterparty risk, delayed settlement, which is what I'm talking about. And of course, there's going to be transaction cost. So tokenization allows simultaneously, or we can say instant settlement through smart contracts. A trade is executed only when both cash and securities are. See, usually, typically, a trade is executed only when both cash and securities are available. You need to have cash, you need to have security, counterparties owner. So that reducing settlement days and lowering cost and improving the efficiency. How does a smart contract works? If you don't know, it just needs conditions to be met. For example, if I write that, okay, my name is this and I want to purchase this, and this is what it belongs, right? So automatically the smart contract will be executed. So if the conditions are met, the smart contracts will be executed. A shared ledger also reduces search friction. Everything is recorded in a ledger, like a book, right? So you can refer to that. So that reduces the search frictions. You want to buy, you want to find a counterparty, you can find it, right? Because the ledger has the information, who has purchased what, who has sold what, so on and so forth. And this sharing of a ledger is very much useful in an OTC segment as well. Okay. By making it easier for participants to find counterparty and improve transparency. Of course, this can narrow bid ask, so obviously the cost will go down. However, this is important point. Tokenization does not completely eliminate counterparty risk, at least before the contract execution, before it is executed. Once we do that transaction, then we do not need that. Okay, then there is no counterparty risk is eliminated. So before the transaction is done, before you get the tokens and everything, there is still a counterparty risk, whether you will get the token or not. That is what the point here is. Okay, so in the terms of asset trading, yes, it does help you to reduce time, make more efficient trading, reducing search frictions. That is what it does here. Then in asset servicing and redemption, which is part of the life cycle of the asset. In asset servicing, it involves cost. So when you in traditional markets, you have cost related to paying interest, principal, dividends. There's a cost involved, right? Admin fees, so on and so forth, along with maintaining accurate ownership records. Tokenization can automate these through smart contracts. Every 6 months, the bond coupons will be paid automatically to the owner. Okay. Payments can be programmed based on token ownership, payment date, what is the amount due. So everything, asset servicing, redemption, you want to take your money, sell your token, everything will be done very quickly. All right, so that's how it does help in the life cycle stage. Next learning objective: explain how the use of tokenization and digital ledgers can impact financial market externalities, including transmission of shocks across the financial system. Tokenization improves liquidity, speed, interconnectedness, but also introduces systemic risk. Yes, it does introduce system wide risk. Remember, I think we were talking about yesterday that high debt interconnectedness is very high, liquidity mismatch is very high. These can amplify financial shock. Typically, if a company has high debt, that's a problem. If the industry is very much interconnected, that means one particular company knows that, okay, there's a problem in it, everyone starts to know about it, everyone will sell. So interconnectedness, okay, and liquidity, asset liability mismatch, these can amplify the financial shock in traditional markets. Fair enough. However, tokenization can intensify this effect because of the speed. There's going to be faster transactions. This means quicker spread of the shock. You'll not even find time to mitigate that. So faster transaction speed reduce the time available for policymakers to intervene, and the shock will spread more rapidly. So that's how it introduces the systemic risk. There's, of course, low issuance cost of tokens. It's low cost, but this encourages high leverage. People keep on buying, keep on buying, keep on buying. Hence, increases default and systemic risk. If it is very cheap, everyone's gonna buy it, right? That's what the point number B here is. There's gonna be retail shifting of funds. Maybe I'll not keep my money in the bank. I'll take it out. I'll invest in a particular token. What happens? The banks, they will have to rely on unstable funding. People can pull out their money anytime. That's again give rise to systemic risk. So people are moving away from bank deposits. They are putting their money in the tokens. That's how it can shock transmission, externalities, side effects. That's what we're talking about. Complex assets, you can have a token on a particular complex asset plus rehypothecation. You can use that smart contract or that particular token. You can use it as a collateral somewhere else. Multiple time you can hypothecate it. So using the same assets as collateral, that's rehypothecation. More interconnected risk chain. Of course, if you're doing so much of complex assets, you don't understand that, that's going to be a problematic situation. And then finally, automated trading via smart contracts can trigger rapid, large scale transaction, increasing the likelihood of flash crash, just like algorithmic trading. Right? So these are the effects or the side effects of having tokenization. Then, of course, in order to prevent these system wide risk, you need to have that infrastructure. You need to have that people who understands these things. You need to have that system and everything that is required to run the tokenization business, right? So under investment in security aspect, right, especially by private operators. Let's say I want to buy Bitcoin or I want to buy any particular crypto, but the operator has not invested properly in security systems. What's going to happen? Cyber attacks, human errors, software errors, system failures, fraud. These are the risks that can happen if the infrastructure has not been invested properly, and this can have its own externalities. So as reliance on digital ledger grows, more people are relying, so does the importance of robust infrastructure should be there, and cybersecurity measures has to be there. And of course all these things does gives rise to concentration risk. If we are just reliant on one particular provider or service provider, then if that anything happens to that service provider, there's going to be a concentration risk. So the point is, there has to be significant money should be invested so that the investors are protected from cybersecurities and all the other risk. What is the network externalities now? We're talking about the side effect of having tokens. Network, when I talk about it, of course, if one is buying token, maybe I'll tell other person to buy a token. You can buy a house, fraction of a house, at just very less cost. So I spread the information to other party, the other one spreads it to the other one. So there's going to be a loop, right? And more users will talk about it, they'll purchase it, and more people will refer more business, right? So essentially what is happening is that having tokenization, it produces more users, it provides greater liquidity, better price discovery, low transactions because the bid ask spread falls down. So this is a positive thing of network externalities. Tokenization enables fractional ownership across a wide range of assets, improving retail participation, and of course it provides diversification as well. So this has a positive things. However, This is where the negatives of network externalities begin. If multiple non interoperable ledgers emerge, now what is a non interoperable ledger? See, essentially, we need to understand who is owning the asset. We need to have that information, right? Otherwise, what's going to happen is, if there's a building, right, you have all these units, no one knows exactly who's owning this, who's owning this. If no one knows about it, there's going to be, essentially, it's like a separate block. This is a separate block. This is going to be a separate block, and no one will have information about each other or the parties that we have. So basically, the point is that this information has to be in a specific ledger, and this information has to be in a ledger. Now, if all these ledgers are interoperable means no one can see the other one, then how would I know whether this is being purchased, it has been sold, so on and so forth? So, interoperability should be there. It's a very good thing. Okay, remember this for the exam. However, when if multiple ledgers emerge, if there are multiple ledgers and they are not interoperable, markets can become fragmented. So this may have its own ledger, this may have its own ledger, there's going to be a third ledger, maybe a separate standalone ledger, like an isolated ledger. So essentially what happens is, this fragmentation increases search friction. Then I don't know where is the price here, what is the price here, what is the price here. This reduces the efficiency and weakens the overall benefits of tokenization. We did we are using tokenization so that we can reduce search frictions. But these fragmentation by distributed ledgers, like interoperable ledgers, this is going to be a challenge. Okay, that's another thing that we need to understand. Knowledge externalities. Can the side effects of knowledge also happen from tokenization? Yes. See, there are positives and negatives here. Positive is that innovators can build upon existing smart contracts at low cost. So basically, what happens is, these smart contracts or these tokenizations, they have an open source code. So maybe I can go ahead to Google and I can find the code and I can just build upon that, right? So the coding is, everything is done. I just need to go ahead, maybe add few things here or there, and I can probably open my own, right? So innovators can build upon the existing smart contract code at a low cost, which will accelerate the technological advancement, right? This is better for the whole community. But just think about it. Will any company have any incentive to invest in R&D? Will any company say that, okay, we're going to be investing billions in this particular R&D of smart contracts? No. So that's a negative thing. That's the negative side. Because code can be easily copied, individual firms may have less incentive to invest in expensive R&D, because they cannot protect their intellectual property. If you can register for a patent and everything, if you can do that, then it's fine. Otherwise, that's a knowledge side effect, that okay, it can be copied. Now, the next learning objective: explain how distributed ledger technologies can impact retail investors and brokerage firms. Okay, so distributed ledger technology, it's so the distributed, it is a part of the blockchain, right? It changes how assets are traded, transferred, and serviced, affecting both retail investors and brokerage firms. Now, we talk about the externalities. Let's talk about the internalities and the market power. Okay, what are the inefficiencies and how tokenization can help? See, what happens in our internalities is, of course, the retail investors. As I told you, that remember the retail investors in mind. So, retail investors, what they do is, they can purchase the tokenized assets. Their name is recorded in a ledger and everything. But what happens is that they do not know what particular asset they have purchased. They probably may not have ideas if there's any complex tokenized assets is being developed, right? So essentially what they do is they simply buy that. And also they bypass financial advisors to save fees. They maybe do not research or probably reach out to a professional. Then what happens? They purchase these tokenized assets. This results in poor diversification and higher exposure to sudden losses. Okay, so that is what retail investors' internalities are: taking wrong decisions, not knowing what it is, not going to a professional, and they suffer in this less diversified and they face losses. Any crypto that they buy, they don't know about that crypto. That's a loss. Market power inefficiencies. Now, as I said, any dominant player, they will charge higher fees, right? So usually what happens is that one of the friction is that limited competition allows dominant players to charge higher fees. Okay, so that's what market power inefficiencies are. Okay, that's how it arises. Traditionally, brokers retain this power. Now, whatever the brokers say that, okay, if I'm trading on Zerodha or any other platform, whatever transaction cost they say, I have to give it, right? So traditionally, they brokers have this power. I cannot buy directly from the company. I have to go through this particular broker. And I cannot even switch to one broker to another. It can be a cumbersome task. In the US, we are talking about the US perspective now. There is a process known as an in kind transfer. So, for example, if I want to, sell something, what happens? I sell something, I get cash, then I pay maybe taxes on it. Let's say I'm selling a share, right? I get cash for it, then I get the, you have to pay taxes, and then I get my money. This is a long step transaction, right? So there's a process like a in kind. It requires intermediaries. Of course, I do not just sell it. It goes to the intermediary like CCP, exchanges, so on and so forth, making it slow and costly for investors to move. So clients remain locked in and fees are still high. Rather than that, what I do is I say that, okay, let's keep the money there only. I'll not switch. This is traditionally what is happening. But distributed ledger technology or DLT reduces these frictions. How? Instant transfer. You want to sell, get your money. Transparent ownership. No intermediaries. That's how they get lower fees. So direct trading between investors and issuers can further pressure brokers. If I want to directly trade, there's no broker, right? However, the broker has to be there because of the regulations that you have to trade via a member. You see that? That's what the thing here is. However, private ledgers can recreate the same issue. This, it tries to solve this thing. It can again recreate the same issue. As an example, you go to a very popular crypto player, let's say Binance or any player. Now, if they are dominant, they may initially, charge low fees, or they may give you free access to purchase tokens and everything. And once you are there in the system, they may start charging monopoly rents, very extraordinary high fees, and monetize the data, the user details, right? Reintroducing the same market power inefficiencies that used to be there in the traditional market. Okay, so essentially, if I talk about market power inefficiency, yes, traditionally these issues are there of the brokers. DLT tries to solve it, but if a dominant player in the DLT segment comes up, they can again introduce these errors. Okay, moving on, compare different models and methods that are currently available to achieve sharedness, programmability, and trust on a ledger, the three pillars that is required. And we have to describe the conditions under which trust fails. Okay, so this is the last learning objective. Let's play attention to it. Okay, so tokenized models, there's a concept of, as I shared, as I spoke about it, sharedness. Sharedness can be achieved via three models. First is a single ledger, second is a common ledger, third is a compatible ledger. So where the information is shared on a ledger, on a book, you can have a single ledger, which means all participants operate on a single system. So let's say Binance or any company, right, who's operating. So you have to buy, sell one single company only. This introduces efficiency, but there is a centralized structure, right? Maybe the regulations are there. So this is a centralized thing. Common ledger, assets from other ledgers are represented via escrow. So there's an escrow account. Okay, there's an escrow account where all the ledgers are maintained. All the ledgers are maintained, and from this escrow account, you get the ownership of a token. That is known as a common ledger model. So assets from other ledgers are represented via escrow. Original asset is locked, tokenized version traded elsewhere. So original, it is locked, but tokenized of that is being traded elsewhere. And the third is a compatible ledger model. Different ledgers use standard technology to interact. And as I said, this is very important because it enables interoperability among the ledgers. Okay, and there is no centralization. It's a decentralized, no centralized. Okay, so that's different ledgers use same technology to interact among each other. So this is a better ledger model. So these are the ways that the tokens can be shared. How it's going to be programmed? Well, there's a code. Programmability refers to the integration of code and data within the ledger itself. Okay, because it is digital, so there has to be code, right? There's a use of a smart contracts. It automate execution of instructions. So no need for external system to process transactions. This ensures consistency and efficiency. Basically, how it is programmed via smart contracts. Coding, everything is done. Now here it is a table that we need to understand for trust and trust failure scenarios. Okay, the very first model that will help build trust is a single operator system. What is a single operator? How the trust is established using this single operator system? See, it is a centralized structure. Let's say JP Morgan, any one particular company that you can think of, they are operating that particular structure of tokens. Okay, so this is a centralized. One entity manages records, validates transactions. Okay, one single entity. So the trust here depends on the reputation of the operator. Let's say JP Morgan. Credible and regulatory is oversight is also there because it is centralized. But this same single operator system, it can have negative scenarios. That is, the entire system depends on one entity, the entire single system. High exposure to operational failure or misuse, and there's no consensus mechanism to distribute trust. So you just have to be dependent upon that. The second type of a model for building trust is permissionless distributed ledger technology. When you create that, keep it permissionless. That means no permissions are required. Anyone can go ahead, they can validate the transaction, they can perform the transaction, anyone can maintain records, everything. So it is a decentralized system where anyone can participate in validation of the transaction, recording the transaction, maintaining the ledger, everything. Trust is built through consensus mechanisms and economic incentives. Okay, there's economic incentives for everyone because it is permissionless. Maybe I can go ahead and I can start validating, start mining the coins and everything, and I can start issuing the tokens. But what is the negative case here, though the fail of this particular trust? 51% attack, majority control of network. That means the people who have high computing systems, power, computing power and everything, they have better computers and everything, they can manage proof of work. Proof of work is a way that means a person who has good computer, a best computer, can mine the transaction very quickly. Okay, so these are the people who will have majority of the control because they can validate very quickly whether the transaction is good or not. They can validate that very quickly. So of course, it's going to be managed by them who has high computing power or system. There can be transaction manipulation because it is permissionless. Anyone can just go ahead and join this particular ledger. Manipulation of the transaction may be front running, sandwich attacks. What is front running? We know that, okay, purchasing right before someone, you get a news or something, you purchase it immediately for yourself, and then when the news hits the market, the prices go up, you sell. That's front running. What is a sandwich attack? Sandwich attack is basically, uh, it's like, for example, if the example here of a sandwich attack is essentially before someone buys. So let's say you are here, you are trying to purchase bitcoins, right? But what I will do is I will go ahead and I will purchase initially just before you. Okay, and then you purchase that, so prices automatically goes up, and then I will sell here. So essentially the point is this, that I am purchasing and selling, you know just before you do, and after you do the transaction I sell immediately. So that's a sandwich attack. Okay, you are being sandwiched here. But it's a manipulation, right? It's a manipulation because the moment you purchase a large block or something, I sell. Because of these permission-less ledger. And there is higher exposure to cyber risk, difficult regulatory enforcement. It is decentralized, so there can be less regulation, right? So these are the trust fails. Then finally, you can have a trust building model wherein it is permissioned distributed. So permissioned is, you need permission, and it's going to be not multiple operators, maybe few operators. Okay, only authorized participants validate transactions, not everyone, but not even one particular thing. There are multiple, but not everyone. So it's a permissioned, you need to have permission to view that particular ledger. So trust is based on controlled access, and there's an oversight by central authority or consortium. They look into this permissioned DLT, and only then they allow these participants. But what is the negative aspect here? The negative aspect here is definitely collusion. All these participants, they interact with each other and they manipulate. Okay, so there's going to be particular potential manipulation. And however, how do you manage this risk? Risk is mitigated by reputation, because no big company or a corporate will not do it. And of course, the regulations should be there. All right, so that is what we have this particular, that's a challenge, right? Now, there's a concept of cloud computing. Cloud computing, it benefits financial institutions, but comes with major risk when I talk about cloud computing. So you're shared the cyber risk with cloud providers. So like AWS, the Amazon Web Services, right? So you store your data in the cloud, right? So there's a widespread adoption increases systemic cyber attack. Multi clouds reduce single provider risk but introduce complexity. So rather than being dependent on one cloud service provider, you can use multi clouds, right? You can store some data in this cloud, some data in another cloud, but that can introduce complexity as well. Frequent outages raise concerns about potential disruptions. Frequent outages can lead to the ICT disruption. So they're going to be shared cyber risk with cloud providers because everyone is using that cloud provider that is hacked. So the entire that's going to be having a widespread losses. That's what the cloud computing is. That's all that we need to know. Now, how the interactions happen between the cyber risk and the financial stability. Cyber and ICT risk at financial institutions can trigger systemic financial risk impacting the liquidity, leverage, and even the customer trust. As I said, this can be little abstract, okay, but just give it a good read, all that is there, not to focus too much on this particular chapter, okay. Integration and contagion effect. So now when you how the interactions between cyber risk and financial stability happens, how cyber risk impacts financial stability. First is the integration with contagion effects. The highly integrated nature of cyber and ICT connections within the financial institution creates the potential for significant contagion effects. So if that is so, think about it. ICT risk, the net banking is not working, or maybe a broking company, they are doing transaction, right? They are trading. The platform is not working. That's going to be a loss to the investors and directly impacting the company, right? Cyber attack. So if they both happen at the same time, right, there's going to be a significant contagion effects. Contagious. That's what the thing is. CIA, confidentiality, integrity, availability of data triad. It stands for this three key principles of cyber security. The impact of cyber incidents on these can vary, and you just got to remember this particular thing, okay? How does the cyber risk and ICT risk impact the CIA triad? How does it impact? Well, if I talk about cyber risk, it can vary. Integrity and availability are often more critically affected than confidentiality. So, integrity and availability is more critically impacted when there is a cyber attack as against. So, integrity, compromised data, availability is not available. Confidentiality is not so much of a concern when it comes to the CI triad for this cyber incidents. Challenges in predicting probability. There is a difficulty of predicting key events due to non-linear contagion effects. So now this is you really do not know what's going to happen, right? You really don't know what's going to happen. How can you predict what is going to be the loss for cyber attack or ICT risk? So it's a non-linear thing. It's not going to be like, okay, the event is this much, the loss is this much. No, it can be a non-linear like this. The losses can go very high, right? So we don't know. So that's again a challenge or interactions between the cyber risk and financial, how they interact. Now it becomes really hard to trace the systemic risk. You cannot trace it out. What happens is that if there is a cyber attack, let's suppose that if there is a cyber attack, okay, just a minute. So something that we are missing here is this. So challenges in predicting probability. Now there is a difficulty of predicting key events to non-linear contagion effects. We know that the contagion effects can be non-linear. So what we do is we use agent-based models for simulation. Here, what we do is we use agent-based models. Agent-based models assess impacts on confidentiality, integrity, which influence liquidity. So what we are trying to do is that we understand that to predict losses, right, of or probability of these events, it's a non-linear, it's not a straight line. It's rather, it can be a non-linear path like this. So what we can use is we can use an ABM or agent based model for simulating the effect on the CIA triad. That's what we can use as an improvement. That's what suggests, which will influence the liquidity and asset values and everything. It will do that. It will help you a simulation, just like a Monte Carlo simulation. That is what the point here is. Now, the next thing is that tracing the systemic risk. It is hard to trace the systemic risk. Cyber attacks might block direct actions like a bank withdrawals, but can still cause financial contagion indirectly. Think about it. There is a cyber attack in a bank. The bank stopped the net banking so that no one can transfer it via mobile phone. But at least I can reach out to I can go to a bank and I can, or an ATM, and I can withdraw it, right? So it's really hard to trace out how the financial contagion or financial impact will be. If there's a cyber attack in my bank, if I cannot access the system, I'll immediately go to the ATM and I'll take my money out, right? So to trace where and exactly what is going to be the system wide risk, it's really hard. So we can use again agent based models here for simulating the behavior of individuals, like how I will behave to identify and understand hidden and systemic risk when it comes to ICT cyber risk. We are very much reliant on digital infrastructure. Financial institutions depend heavily on digital infrastructure, including the cloud computing. So, quick recovery from cyber incidents is essential to maintain financial stability and continuous operations. Just pretty basic. Impact on customer confidence. Cyber risk can diminish customer confidence, potentially leading to bank runs and systemic financial instability. So that has an impact on the customer confidence as well. Okay, now this is something that you can just use it out. Specifically, the macro prudential tools are something that you should know. But financial stability policies, how can you ensure the financial stability? What are the policies and tools? Two ways that you can do it, on a micro-oriented tools and the macro-oriented tools. So digital resilience, what is it? Protecting digitally resilience, bouncing back. Protecting financial systems from cyber and ICT risk requires a two approach. Micro, that's operational guidance for individual entities. Framework policies, it's the fundamental rules for network and system operations. Okay, it's two things at an individual level and framework policies for that. So now we're going to be talking about two things here. The first one is the policy measures and micro level or micro oriented tools. Okay, micro oriented tools. So IC is the International Telecommunications Union. It implements, so this is just a union, okay? It implements cyber resilience measures, emphasizes certification and standardization for effective cyber security, just like ISO standard and everything. You can just compare it with that. European Union, it established policies for incident reporting and information sharing. If there's a cyber attack or ICT risk, what happened? Report the incident, share the information. That's what the European Union. There's also a DORA Act, Digital Operational Resilience Act, focuses on ICT third-party risk, including cloud computing, mandates penetration stress test to improve. So this is just to give a good read. No need to remember it and no need to get too much deep into it. Okay, just the policy measures on a micro level that you can do it for incident reporting, information sharing, implement the cyber resilience measure, have a certification of the International Telecommunications Union certification for that, standardized, right, for effective cybersecurity. That's the policy measures and micro level oriented tools. At a macro prudential tools is the first thing that you use is circuit breakers. Now, circuit breakers act as a temporary pause on normal rules and regulation. They provide a temporary stoppage to some services. Think about it. If there's a cyber attack, right, you can stop the net banking for about, let's say, 30 minutes, as an example. So you can inform people and that, okay, or maybe you can just stop it, the services temporarily, you just stop it 5 minutes, 10 minutes, so that you have time to recover from that cyber attack. So that is what we call it as a circuit breakers. Okay. Circuit breakers act as temporary pause on normal rules and regulation. They give us temporary stoppage to some services. In the event of a major cyber incident, circuit breakers serve to minimize the negative impacts. Okay, so that you can just get back to, you can get back to, or you can take care of that particular risk, or there's a service outage, anything like that. So challenges include defining the severity of a cyber attack to warrant the activation of. So when do you activate this circuit breaker? That is a challenge. Now that totally depends on the severity of a cyber attack. If it is small level, high level, what is it? That's what the thing here is. So that's the circuit breaker. It's a good tool that you can use to have a temporary block on your services for a certain point in time, and then you just bring it back. Okay, so that you get enough time to work on it. That's what the point is. However, the challenges is that what is the severity, and then you activate the circuit breakers. The second is that of a cooperative arrangements. So cooperation among financial institutions has become essential for developing robust defenses against cyber attacks. So if there's a cyber attack in one bank, let's say that, then if you get to know that, okay, do not use this particular thing, do not visit this website or that phishing email, whatever that is, if there's a cooperation among banks or financial institutions, you can share it, the cyber attack details, and that, so that others can stay away from that. Information and knowledge sharing resources. So information and knowledge sharing resources facilitate growing cooperation to combat cyber threats. So have good information and knowledge sharing. That's what the thing is. Structurally, you can do something, create a structure, you can take a structural measures for that. So regulating systemically important technological institutions, not financial, technological I'm talking about, you can regulate them, okay, who are very technologically important, right? Forced diversification, you encourage the institutions or bank to use multiple cloud providers and not being dependent to just one cloud company. Penalties for concentrated software use. If you're using a software very heavy dependent on that particular software, there's going to be some sort of a penalty for that as well. Now, ICT buffers is something, the information communication technology buffer is a part of collaborative measure aimed at combating systemic risk and ensuring rapid recovery from major cyber attack. If there is anything, you have certain amount of buffer. Co-owner bank. So what can be doing is that, let's say in my bank, there is a cyber attack. So next to me is another bank. So that another bank can allow my customers to transact on that. So that's a co-owner banks affected by cyber attacks can allow customers to transact on their accounts at unaffected banks, reducing the overall risk. So that's something that we have it here. And I think just a good read is all that is needed for this particular chapter that we have.